the light. Yeah. I always behave as you behind.
Sit down first and then all through.
Good morning everybody, and thank you all for turning up this morning for this meeting of the South Yorkshire Pensions Authority. We have an agenda, I hope everybody's got the agenda, and the pink papers at the end. But the first item is apologies. Do we have any apologies?
Yeah, we're in receipt of apologies from Councillor Mixstone.
Yeah, no. Anybody else? No. The next item is announced, I believe George will announce it to a person that I have a lot of regard for and respect. You'll see why in a moment.
Chair, members probably aren't aware, but this will be Martin McCarthy's last meeting of the Pensions Authority as he's leaving Barnsley Council after the local elections in May. Martin has been with the authority, boy and man, since it was created in 1988, and before that with South Yorkshire County Council. On a personal level, Martin's given me an enormous amount of support in terms of my role, and an informal conversation with him was what persuaded me to apply for the job in the first place, so I owe him something of a debt in that way. But the authority owes Martin a great debt for his wise counsel over so many years, and it would be wrong if we didn't properly recognise Martin's service to the authority. And we've bought you a small gift, Martin, and if you'd like to come up, the chair will present that to you.
Thank you.
Can I just say before, I'll try not to echo what George said. I've known Martin for 22 years now. When he could start work in Belfast, and it was on the fire service. We're through that. This man, like you said before, yeah, I've got a great deal of respect because he always gives people respect all the way through these years I've known him. And he'll help you any way he can. He's just one of these people that's the way of being nowadays. He will help elected members, he believes in elected members. And I want to say I'm proud to know it. I'm proud to present you with this.
Thank you very much. Just to say, members, thank you very much. I really appreciate this. It's been an honour and a privilege to work with the joint authorities and with colleagues here at the Pension Service. And you know, with the new building and the new arrangements, I think it's probably a good time for me to get out. But I wish you all the very best for the future.
Are there any urgent items, colleagues?
No, Chair.
No. If not, then shall we move on to agenda item 4, consider the absence of the public and press to identify where resolution may be moved to exclude the public and the press. I believe there's 2 items at the end on pink papers today. Are they the only ones?
Yes, Chair.
Yeah.
Chair, just on that one point, the very last item, I'd ask that other than the members of the authority, the active members of the authority, myself and George, that we'd ask all the people present to leave the room on that very last item.
So it's members only for Martin and George?
Yes.
Thanks, Chair. Thank you, Martin. Thank you, Martin. That's why it is. 5, are there any declarations of interest, please? Anybody at all? No? Good. Section 41, feedback from District Council. I'll go to Dave.
Yes, Chair, thank you very much. I did mention in Doncaster full council meeting that we had recently that the new building was here and that meetings are going to be held here in the future and that you did open the building on everybody's behalf, so thank you for that.
Marsley?
Councillor Stokes. Not you.
Okay. Sheffield?
Yes, Chair. I keep mentioning it at most meetings I come to, but I've just got to say it again, I've been inundated from members of the Green Party and Greens in Sheffield, where they're asking about our investments. And of course, I'm not very clear on all that in what we invested at this moment in time. I've sent it over to George, and I get a nice complimentary reply back in great detail. So I do appreciate that, George.
Okay. Rotherham? Rotherham?
Yeah, I've had similar questions from residents, so we're grateful for what George writes up for us and sends to us.
I do believe that I do believe that items on there which will be discussed, and sorry, highlight the point that you've been raised. I heard from your citizens or your voters, etc. So it will be discussed. I think we'll be dealing with gusto, I think it will be. Because the public will have questions, as well, I do believe. The minutes, so agenda item 7, they're on page 5 to 10 there. Colleagues, can we roll them with the total regular, please? Agreed. Anybody do anything? No? Thank you. Agenda item 8 is the performance report on pages 11 to 40. And Gillian, I do believe this is yours.
It is. Chair, good morning everybody. So yeah, this is the third quarter report for this financial year, providing an overall summary of performance across the organisation. The main headlines are provided on page 14. And section 3 sets out the main activities that have been taking place during the quarter across the corporate plan objectives, which shows that generally good progress has been made on many of the objectives. It does reflect that a small number of the objectives, whilst they are now being achieved, were delayed from the original timescales that we'd set, which is due to various factors such as lack of resource, due to the number of projects taking place and having to prioritise different areas and so on, and in some cases procurement delays. Sickness absence levels have reduced in quarter 3 compared to the previous quarter and also to the same time last year, and that's mainly due to the return of those people who were on long-term sickness absence in the previous quarter. And sort of following on from that, performance on the pensions administration measures has increased this quarter due to the return of those people from the long-term sickness absence. The forecast outturn against the operational budget set out from page 23. There's an overall underspend before transfers to reserves of 181,000 that we're forecasting at the moment, and that's a small reduction to the underspend that was forecast at quarter 2. And the reasons for the main variances on that budget are set out in the report. The table at paragraph 4.53 shows that the proposed transfers from and into the reserves at the end of the year. The majority of this is using the capital projects reserve as we had planned to do in order to finance the capital costs of the Oakville House project and also the implementation of the new contract for the pensions administration system. And we're also proposing to transfer the underspends from this year's revenue budget into reserves at year end to be used for specific projects across the corporate plan delivery in future years. Pages 27 to 28 of the report set out a proposal to add an extra senior finance officer to the finance team, and that's in order to address an identified resourcing need that we've got in order to enable us to get the full benefits and the planned way of working that the service restructure is designed to achieve. The full details and rationale are set out in the report, showing that the cost of this will be £35,000 per annum, and in 2022-23 that will be funded from this year's staffing underspend, which will be transferred to reserves at year end. The appendix to the overall report at page 33 includes the risk register, and that contains the commentary on each of the risks that were reviewed most recently in February. I think that was all I wanted to highlight and introduce in the report, but I'm happy to take questions here.
Colleagues, any questions to Gillian on this report? David?
Thank you, Chair. On page 16, there's a clear residual backlog cases, and the project team has been set up from the 1st of January. Can we give a sort of assurance that when this team is set up and working, that within maybe 6 months that the figures will then be cleared, or gives an idea of when they will be cleared?
Yeah, absolutely. So that's my area. I'm happy to take that one. So the project team was set up as planned in January. For most of January, they were primarily working on some data improvement work, principally to help with this year's pensions increase run. But from February onwards, they've started working on the backlog itself. So we'd be happy to present some statistics next time round and give you that assurance that the backlog is reducing and progressing. I haven't got any exact figures to hand, but progress is being made against that backlog. We'll be happy to report on that. That would just provide that assurance that the backlog is sufficiently reducing. We do, for reference, we do routinely report that information to the local pension board as part of their
Okay,
Can I ask a further question? On page 21, you've got an actuarial target of 6.3% and a benchmark of 9.3 and performance of 10.7, which is great to see that performance. And I was just wondering, is there a correlation between those, or is the actuarial target the base minimum that we wanted for investments in the future?
Yeah, the actuarial valuation, that's the target there is the minimum that we have to achieve. Obviously, we've set a benchmark, and we look to outperform that. I think if we met every individual portfolio met its target, we would be outperformed by about 0.5%.
The benchmark is a combination of the different indices that we measure the performance of individual portfolios against. So that is just what the stock market has done in that quarter, basically.
So we'd hope to, that's the minimum that we would hope to do. Obviously, we have our performance targets, but that performance more than matches the targets.
Thank you for outperforming those targets as well.
Yes, sir. I've got your name, sir.
Simon Jones.
Carry on.
Yeah, page 31, in terms of breaches of law and regulation. I'm just wondering about the 2 breaches where the AVC premiums were incorrectly made visible. I'm just wondering how we picked this up. Was it our internal processes, or was it?
I wish I could say that it was.
Right.
Unfortunately, it was a member that had logged online to our portal and identified. We had actually attempted to redact the other names, but just the way that the scanning had operated, the names were showing through underneath. So it was a member that highlighted it, but having the member highlighted that, we then checked our records to make sure that there weren't any other instances, which is why we ended up with 2 cases. But we've carried out a scan of our database now and made the appropriate amendments to remove that data.
Okay,
It's worth saying actually that the data that was visible was only name and national insurance number. It wasn't particularly detailed.
But it was because it had been scanned in and not redacted properly.
Yeah.
Thank you.
You okay with that, Sarah?
Yeah, thank you.
Okay.
Well, I was hoping it would be our internal process. Sadly not.
Any members' comments? No?
I just wanted to ask about I wanted to ask about the risk register on page 34 and around the induction and training and so on of ourselves indeed, because having briefly filled out the self-assessment audit, I certainly identified a lot of gaps in my own knowledge around this in terms of strong evidence, so I just wondered what steps we were taking to ensure that those training needs were addressed.
So we've now got the composite results from all those things, and thank you to the members who did fill that in. We will use that to help frame the training programme place. We don't particularly have access to your individual results. So if when we've produced the training programme, there's something that you've highlighted in your own thing that isn't in there, have a conversation with one of the officers, and we can set stuff up. That might be a one-to-one conversation with the relevant officer, or it might be that there's some reading or some event or something that just depends on the nature of what the gap is. But given the composite results, I would anticipate there will be a fairly comprehensive programme over the next 12 months, covering the broad suite of issues, and that's partly driven by the business cycle as well, because clearly this year there is more actuarial stuff this year than there would normally be, because it's a valuation year, hence we've got the actuary with us today. So, you know, I know a number of members have highlighted actuarial things as one of the things they need to know more about.
Okay, Sam? Yeah. Can I, on the same sort of theory of what Fran said there, if you look at page 35, there's one issue there marked red. My question is, the third pad where is red, it's about climate change. Should we be concerned, or is it just a blip?
Well, it just reflects the nature of the risk, Chair. I mean, we for next financial year and going forward, alongside the revising the corporate strategy, we rebase the risk register, and there are a number of risks that have, based on that full reassessment, turned red. So there's more red on the new risk register than on this one, but the climate risk will remain red until we've got a trajectory that meets in terms of reducing emissions, that meets the authority's goal. And as you'll see from papers elsewhere on the agenda, we are some way from being able to meet the authority's goal. We'll convincingly state that we can meet the authority's goal, so it will remain red until we get there.
Yes, Steve?
What would need to change? I mean, I know it's hypothetical, but what would need to change to reach that goal? Because, I mean, I completely get what you're saying, Joe. I mean, I think personally, my own personal thoughts are that I don't think that 2030 is achievable. But is it? I'm sorry, Jordan.
I mean, we'll talk more about that at a later item on the agenda, but 2030 is extremely challenging. There is a high risk that we will not achieve it. There are things that we could do that would make it more likely that we will achieve it, but those in themselves represent challenges to some of the authorities' long-held beliefs and ways of doing things. And those are things we are going to have to discuss over the next 12 to 15 months as we look to review the investment strategy. Although we also need to give our colleagues at Border to Coast time to actually implement the changes that they're making to the way they run their investment portfolios to make them more climate aware. Because we shouldn't be making precipitate decisions, particularly as we've agreed to a set of changes that haven't yet taken place and we haven't seen the impact they will have. So but as I say, there are a number of items later on the agenda where we'll talk about that in some more detail.
Can I just, but not remind, but just refresh me. especially our elected members here, we did agree in September last year about the target of 2030, where I must emphasise that was with a balanced view of the situation that would occur in between. It was not a 2030 you're going to get this done, but not at all. It was to take account of the markets at the time, how to be fixed interest, all that, and also what's happened. But now you've had a Spanish in the works, what's happening in Ukraine. But like I said, these things will try and test it, but it is a balanced view approach to get to 2030 to see where we are then. And like George has rightly said, we will ask Board of the Coast to come back and talk to us. And I'll tell you now, we had a meeting last Tuesday, Wednesday at Northampton. One thing we did raise about the issue there, we will be getting a fortnightly update from Board of the Coast on the situation with investment in regard to the Ukraine and Russian situation. So that will come out to you in a fortnight. So when we get it, it'll come out to you. Is that right? Okay? But it was a balanced view by the whole elected members. The situation in regard of this climate change, and I'll say that it's massive. It's on everybody's lips, up, down, stupid, the Russian stuff. It still is a bit, but we must take good niceness of what our community, what our people tell them, what they're asking. But we as a body have to make sure we get a balance thing there. The overall and the overarching thing, we must be right and by our scheme members to make sure we get them the best benefits possible, and that's where we should be. That's where the balance comes in. I'll leave it at that, okay? Can I just ask on 2019, do you know what I said? Are we happy with our reserve situation, the reserves?
Yes, yes, Chair, we are in quite a fortunate position in some ways that whilst we've underspent on the budget, that does allow us to transfer some money into the reserves this year, which hadn't been planned because we were planning to pretty much use it all on the capital projects. But with the underspend, that allows us to transfer a reasonable proportion back into reserves that will then equip us going forward, as I say, to meet some of the corporate plan delivery that we've got on the projects that we've got planned.
Any more questions, comments, colleagues?
Can I just ask about reserves? Thank you, Chair. Just what sort of base level do you tend to keep reserves at then, historically?
So we've set ourselves in the medium-term financial strategy a limit of no more than 7.5% of our revenue budget in the revenue reserves. And yeah, we stick to that, and we're bringing it down a little bit, but we wouldn't want it to get, too low. So it's kind of keeping that balance. And at the moment, yeah, we're very much in the reasonable range, just below the 7.5%.
It's worth adding, Chair, that the capital projects reserves were set up on an exceptional basis because we were doing the project that you're sitting in, and that's a once in 30 years project. So we have, just purely in cash terms rather than against the targets, we were running higher level of reserves than we would ordinarily do. But the sort of 7.5% that Gillian talked about accommodates things like our IT replacement programme and things like that on a rolling basis.
Okay, colleagues. No more questions? Gillian, thank you.
There's just two recommendations on page 6.
Sorry, after that, yeah. The recommendation, I've got one line in here, it's approved the other transfers to and from earmarked reserve and set out in the table paragraph 4.53, currently forecast to amount to a net total transfer from reserve of 1.185 million, and B, approve the addition of one FTE senior finance officer to the staffing accountant and finance corporate service. Are we agreed?
Agreed.
Yeah. Agenda item 9 is AFN, and it is on pages 41 to 50, and it's AFN, for yours.
Great. Well, thank you. Well, first thing I'll start with saying is happy St. Patrick's Day. I'm wearing green. Thank you, George. The wall is green. It feels very festive today. So, and I'm delighted to be here, notwithstanding. So, obviously, this has been a very busy time in markets, and we really are dealing with this clash of narratives. When I wrote this report, we really hadn't seen the escalation of the Russian situation in the same way. But the first narrative that the market and investors and consumers are grappling with is the end of COVID and what that means for economic growth, what that means in terms of inflation. We're already seeing quite high energy prices even before this additional escalation. And now we're dealing with the additional narrative of the war in Russia and Ukraine, and what that means for not only geopolitics, for prices of energy, but also for ESG matters going forward, as this has really brought into focus what it means to find a governance scheme unpalatable, intolerable, uninvestable, and there has been fairly fast concerted action around that. So this will, I think, we will look back on this as very much a watershed moment for many reasons, but certainly in terms of geopolitics and in terms of perhaps the integration of ESG in our daily lives and in the sphere of investment. So what was happening at the end of the year? 2022 has certainly been anything but predictable. It's at the beginning of the year we clearly saw that Omicron had killed the certitude that we thought we knew in terms of the end of COVID. It seemed to be a setback that markets weren't expecting. We saw that was then sending many of the tech stocks that had been leading most of the drive in the US into free fall. And what actually happened was that the FTSE here in the UK was sort of seen as actually bucking the trend in global markets, because it is very much an old economy type index. Had exposure to banks, which normally do well in a rising rate environment, and it had exposure to many of the mining stocks, some of the fossil fuel producers. So these were all doing very well when tech and some of the new economy was sort of falling over. So that looked good for a while, until then, of course, we had the outbreak of hostilities in the Ukraine, which then, of course, led a question mark around the state of European banks and anyone with a lot of exposure to Russia. And it also looked like, even though fossil fuels were doing well, there was just tremendous uncertainty and threat to economic growth. And we have this whole question, what are we prepared to tolerate in terms of our principles, but are we prepared to tolerate perhaps sustained inflation on the back of that? Inflation has been rising globally. It's very difficult to attribute a cause to that. Is it because of energy? Is it because too much liquidity has flooded the system? Is it pent-up savings from COVID, or is it supply chain restrictions that are still working their way through? Because many of these factors are temporary, such as supply chain restrictions, it could be that most of the inflation we're seeing today will not be sustained. That said, we are seeing 40-year highs, and that's the type of number which harks back to the 70s, which sends the pundits into overdrive in terms of their speculation as to what's to come next. We've seen levels of up to 8% in the US, and then 5-6% here in the UK, and that has then provoked fairly assertive central bank action around interest rates. So the Bank of England, having stalled for some time and disappointed markets by not raising rates, then raised rates in a back-to-back fashion, and we just saw yesterday the Fed beginning to raise rates. It is suggested this is going to be there'll be 6 further rate rises in this year and a further 3 next year. There's the Fed's telegraphing. We can see something similar expected globally. And what will that mean? It still actually is going to get us to a fairly low level. So we're still not in the kind of rates that would actually stymie economic growth. Clearly, we see central banks very much afraid to stymie economic growth. There is a fragility in markets, a volatility that they don't want to push against. And so we'll probably have some, despite the raises, a fairly timid action. All of this is important to you because obviously inflation affects the forecasts, affects consumer behaviour. We've all seen our energy bills go up, and that affects retail, how retail does, how consumer stocks do. And equally, inflation affects your portfolio as well. And you do have built into your portfolio inflation hedges. Typically, real estate and infrastructure would be decent, explicit inflation hedges in the portfolio, but equally in equities, which you have almost half your portfolio allocated to equities, is generally a loose inflation hedge. So the good news is they should participate well in a high inflation environment. Usually what doesn't perform well would be bonds, and bonds equally don't perform well in a rising rate environment, although I do have a slide in here later suggesting that it's not always as bad as all that. And actually they can eke out a decent hedging return. And bonds do also tend to be a good, solid performer when we have a flight to safety. So in terms of where we're going from here, a lot of indicators, whether it be the backwardation of the oil curve or the fact that the yield curve is fairly flat, suggest that probably these are short-lived phenomena, but the oil price being high as well as inflation looking like it'll rise in the short term, and interest rates looking like they'll rise in the short term. That's all looks like it will probably even out and balance out in the years ahead, which should be strong for economic growth. I don't think we're in a stagflationary environment, primarily because we don't have those same levels of unemployment that would have been seen in the 70s there is momentum around economic growth, around recovery from COVID. We've seen governments prepared to take a strong line in intervening there, and equally labour is so tight right now. We're nowhere close to the unemployment levels. In fact, most places have severe difficulty in actually filling positions. So that probably speaks to some underpinning of that. In terms of other indications which have been interesting to see, we've seen the dollar remain very strong. And that is actually, doesn't tend to go, usually in an inflationary environment, the US dollar will fall. The dollar is strong, which has been good for your portfolio, which has a solid global exposure. Whenever sterling is weaker, that is ironically actually quite good for your portfolio. We saw that boost in 2016, and when we tend to have the extra pickup in rates from that. In terms of equity markets, they still remain very disappointing for the year, but there's a strong underpinning of demand. So whenever markets fall, just like yesterday, yesterday the Hang Seng was up 9% in Hong Kong. It was up a further 7% today. So clearly there's a lot of buying, desire to not miss out and buy into weakness. So that should provide some underpinning around equity markets. There has been a lot of talk about does it enter bear market territory in the NASDAQ or in the S&P. FTSE hasn't entered that yet. But I think I have a chart on page 46 just showing the reminder that on average there is a decline of 5 to 10% in an equity market every year. So that's the approximate frequency. So even though it's not something that many investors are used to and they don't like to see, that is very much in the range of what we should expect from equity market performance. So not to get too perhaps focused on that, even if it is high single digits or into double digits, that's the kind of ride we expect in equity markets, and it's best to not try to get too focused on the day-to-day volatility. The slide on page 47 also shows how bonds do tend to do well in a rising rate environment, not as well as equities or not as well as other asset classes, but they don't always have a bear market themselves. It's important, we also have other asset classes. UK property has been very strong, surging in February in terms of house prices, and it's been the fastest level in 10-15 years in 2021. And the other point I wanted to make in this was around levelling up. Clearly there's been a lot of focus on that white paper that has been issued, which has been recommending 5% invested in local projects, local meaning the UK. We are going to see over the summer fleshing out of what exactly that means. But certainly in terms of our coming more into infrastructure, the local investments that we have, whether it be in farmland or elsewhere, and just looking through our UK portfolio, where that is providing UK exposure, I would be quite confident that we're already more than meeting that obligation. But it is good to observe that that's certainly somewhere where the government is looking to have us go. So in terms of, I've said this 2 quarters, but it's really the point still holds that we are in this VUCA environment of volatility, uncertainty, complexity and ambiguity. The complexity sometimes gets missed when we have these headlines that tend to be quite absolute in terms of outcomes, whether it's calling for no-fly zones or divestment across the board from all emerging markets. And I've seen it all in the last few months. So I'd say that we are going to be, in this complexity, we are still quite positive on what this means for risk assets. And actually the complexity usually bodes well for stock pickers. What this also is important to note is that this is really bringing ESG issues to the fore. And that will be something that we start to watch more and more, is just what this translates into in terms of the momentum around, say, renewable energy. Since we've seen that energy security is of supreme importance now, does that mean that we want never again to be reliant on a natural gas pipeline, say, from Russia, that this now will accelerate some of the trends that are already in place? And that would not only acceleration of the trends, but also accelerate focus on what we're prepared to accept from a governance standpoint and what we're not. And I would suggest that could open quite a lot of can of worms, actually, were we to look around the world at other governance regimes which may not meet the standards we are expecting, and what that means for emerging markets, perhaps. But there is some light, I'm saying, at the end of the tunnel, is that areas such as China, they have come out today with a very yesterday with a very affirmative statement around their commitment to markets and to shoring up some of the companies and the tech stocks that are there, and that was a very reassuring indicator. So it sounds like I think we have some good leaders. We're seeing that things are being steered in the right direction. There's some good news coming out of potential peace plan out of Russia, Ukraine, and we will certainly be watching this very complex situation very carefully going forward. Can you take any questions?
Sorry, could I just add something before you? Could I inject a little bit of an element of caution into this?
Perhaps it's because I'm a bit older and I've seen the 70s. But I'm slightly worried about this, the background we've got at the moment. I think even if the war ends, which we all hope it does, markets bounce, that's fine. But I think there's a risk of inflation being more persistent than people are expecting at the moment. It's going to take time to work your way through some of the issues we've got, the supply shortages, raw material prices. There's going to be wage pressures because we all know the cost of living issues that people have. That's true in America as well, by the way. And if we have a phase where inflation is a bit higher, even if central banks are raising interest rates, it could be quite challenging. Because all markets are on, bond yields are low, equity markets are on high valuations. Everything's priced on a decent scenario that that we're going to have low inflation, low decent growth for the future. So if that's challenged, and we have persistent inflation for a bit longer, it could be quite a bumpy phase for markets. I'm not suggesting we'll go back to the 70s, I hope not. But I do think that one should have an element of caution at the moment, particularly if we get a bounce in markets after, hopefully, the war ends, that's not us out of the woods, because I think inflation's going to last for a bit longer than that, and it's going to be a challenge. That's my thought.
So people, thank you for that, Robin. Can I just, before I ask a question of my colleague, just like to get this clarified, because I am a layman, right? I'm not the economic expert that you people are. But when I hear about this geopolitical thing, global risk, etc., I look at this now, I try to get some idea of what it is. What I've wrote down here is that geopolitical risk is that internationally it poses increasing management challenges, particularly at board level, and also increases volatility in the previously stable regions. And the uncertainties that follow political change are key political drivers of familiar and emerging markets. Is that a fair context of what geopolitical means?
Yes, I'd say that's a fair assessment, fair summary of what it means. And geopolitical risk has always been there, particularly in emerging markets, where they have less stable governments, perhaps less obvious democratic structures, and less governance norms, fewer governance norms, and less respect for the rule of law. So that's always been a factor. But the idea is when you take risk, it should be compensated. So that was known risk, and it was compensated in that the return that was expected from emerging markets was higher in order to compensate for that risk. So that there was a risk of loss in some areas, and that's why emerging market portfolios are well diversified by region. Brazil, India, the typical less contagion of those, but you would expect to be compensated for it. Part of the issue with markets is it seemed that they were somewhat numb or blind to geopolitical risk until this quarter, in that there was a lot of geopolitical risk cascading through markets, whether it was in the Middle East and Israel, coming out of other regions, and certainly Russia was building their troops on the border, but nobody was paying any attention to it until the spark went and the fire was lit. So that seems to be the way markets are reacting now. They don't react at all, and then they react all at once.
Just to keep it going, when you look at the situation, what happened in Syria and the Yemen, markets weren't affected as drastically as what's been happening now. Is it because Putin and the big hitters got in there and invading an innocent country? Is that what they have supplies of what we require, gas, oil, etc.? That's the big driver here. That's where geopolitical comes in, because it's a change from them to us. But the other thing, at the bottom of page 41, it says it will likely be a fractious quarter, and we will be watching closely, trying to endorse that we do it. You know, we need to keep us. I'll reiterate this to my colleague members. I'll get a letter. When the Joint Committee sent out the written reply to my questions I asked them, you will get that straight away, right? But they will also be giving you fortnightly updates from all the coast on investments. Questions, colleagues, anybody? Yes, Chris.
One of the things you said about that we were at the end of COVID, yet we've now seen the last fortnight infection rates going up by 30-odd%, and although it's not transferred into vast hospital patients, they're also saying there are other variants starting to come through. So are we in a danger there of going back into a lockdown situation? How will that affect the investments that we do, because if people are not working again, and there's going to be this inflationary pressure and cost of living pressure, are people just going to say, forget about COVID, I'm going to work through it? And that, again, may raise the rates of infection and cause other difficulties.
Yeah, that risk has not gone away, certainly, in terms of COVID, and certainly see even in China now, lockdowns in cities, and Hong Kong having a second wave. This seems to be the Omicron variant again, but they had not had that really herd immunity build in the community, so it doesn't seem like it's a separate variant that we need to worry about there. But that risk remains. I'd say we have to also look at, I suppose, how science has evolved in terms of vaccines and how political, how policy would go down in that respect. And I spent a lot of time in the US, and I know how political that has become, and what a divisive issue that has become around mask wearing or shutting down economies or vaccine passports, etc. I think that there is, especially as elections mount, and there's going to be midterm elections in the US, I think there will be very little appetite to introduce more restrictions. So it may be that this now is not, unless it's a new variant that is more deadly perhaps, and one's imagination could, I suppose, there are no limits to what we could imagine. So yes, that risk is there. I'd say given the more knowledge that exists now, there probably is a lower risk, and it's certainly not unthinkable any longer. Part of the shock of COVID was that the restrictions were unthinkable, and now I think there is perhaps an ability to switch between hybrid working, remote working, more seamlessly than before. But I'm not sure Mark has even the capacity to think about such an eventuality at the moment, busy focused on Russia-Ukraine.
Yeah, I can understand the situation in America, but surely the gazpacho colleagues will be able to sort things out. You'll understand that one.
Oh yeah, there was
some people might not understand that.
Taylor Green,
yeah.
Okay, Chris?
Thank you.
I've got Andrew, then I've got Neil, okay? Andrew?
Thanks, Chair. Thanks, Ethan, and happy St Patrick's Day. I think what the last few months has shown is just how hard it is to, and how hard looking at the future is, and how many people get this future prediction wrong. So I mean, I think I wanted to really sort of comment on sort of three things. First is sort of this now. How long are we going to be in a period of high inflation and but also high interest rates? Because we've had a number of years where we've got used to very, very low interest rates and inflation slowly going up, but then all of a sudden, and partly the bounce from COVID, but there's clearly other factors. So it's a very different environment globally. I think, secondly, a much smaller point, but I mean, I'm sure we will come back to this a bit about the 5%. UK infrastructure, and the Chancellor George Osborne said in 2013 that's what he wanted local government pension schemes to do, and we'll come back to it in the summer, but it's clearly not as easy to do in terms of finding finding the right sort of schemes for pension authorities like us to invest in. But I think the third thing I just want to talk about was the Russian invasion of Ukraine, because I was never somebody who said 89 to 91 was the end of history, that it was the victory of the United States and Western Europe and capitalism had won. I never saw it that way, but there has been, for whatever reason, this invasion, this war is different, and we've now seen lots of European countries change their stance. So Germany has changed its foreign defence policy more in the last 2 weeks than in the previous 20 years. And I think the level of that, given the size of the German economy, I mean, I think we're seeing a major change. And I think, as people have said, we're a global investor. And this is not the first of Putin's actions, but it is the first one where the West has taken a very hard line in terms of how putting in really tough economic sanctions, hopefully to achieve a diplomatic outcome. I cannot see how we go back to the normalised relations we had with Russia in the early 90s, and I believe that Russia and Belarus will just become part of a global trade system. I think that's gone. I think it's gone until Putin leaves the scene, and it will probably take, I think it's going to take at least a decade to unpick that damage to the relationship, and I think that will change the way we invest and change the way investors across the world look at other emerging markets and other authoritarian regimes. So I think it's a bigger change for me as the change we experienced in 1991. That was a belief that a time of hope where we thought lots of countries would come into the Western world, and many have, particularly in Eastern Europe. And we've seen that the growth in the Far East, but now I think we're up against this challenge in terms of what we do with Russia and Belarus, but then the bigger question is about what we do about other authoritarian regimes where we currently trade with them, they're part of global investment, but we've seen in the last few weeks what happens when it goes wrong, and I think we're going to ask some very big questions about other authoritarian regimes that we currently trade with.
That's a great question. I'll just address them very quickly. So in terms of how long is this high inflation, how long high interest rates, certainly I think lower for longer was the mantra for a very long time, and interest rates remain low for really the best part of a decade. And there's no sign that that is going to change. The central banks are more assertive, more. They're not as focused. They're focused on inflation, but they're happy to see a little bit of it. They were very focused on getting it going. And therefore, and they also realise the importance of not having too much of a stripped down and too anemic in economic activity. So they definitely need to stimulate economic activity. So I see that we will have rising rates, but as I said, even if they get to 2.8% in the US, which was the end of the cycle they're anticipating, 9 rate rises, still actually very low. So we're not into kind of the high inflation type rates that we would see. And I think inflation is already, the oil price has already come down. It may not have been seen at the pump, but 130 down to 90, that's actually quite a considerable fall. There is a point, the concept of demand destruction when you get to a certain point. And similarly, the oil price just can't go up forever. And there will be, consumers will rein in expenditure, that will rein in inflation. And there were other deflationary forces that were responsible for inflation remaining low for so long. The gig economy, more outsourcing, more globalization. Some of that may change with this focus on keeping things local. So there's a very complex set of really factors feeding in. And Japan has had high energy prices, but they still can't get their inflation off the ground, so that they save so much. So in a sense, all of these factors will build in, and we just don't know. The 5%, I think it's very notable. I would actually suggest that white paper is a very good read. It's very well written. It's very aspirational, but I think it's quite. You feel quite uplifted after having read it, in terms of what they're intending to do in terms of place making and sense of pride and really investing in local areas. So I'd suggest it's actually going to be easier to get to the 5% than we think. We're probably already there if we were to actually look through the portfolio. The question is going forward is how we can really bring together the desire to have net zero in maybe the buildings that are built, as well as bringing in the local community. And that's a very encouraging thing. And yes, I think you're right. I think we have to just bear in mind we're still in the middle of this crisis right now. It's only 3 weeks in. The level of deaths, tragic as they are, is around 15,000 to 20, I think, in the Ukraine, compared to Yemen, which I think is 250,000. So I think that it's still small in the scheme of things. And I do believe it is a watershed moment, I agree with you. But whether we look back and see it as been the sea change like in '89, I think only time will tell. But it certainly is. There was a red line crossed here that was should have been drawn some time ago. But now that it's been accepted to be crossed, it has certainly forced the hand of in geopolitics, and that's something that we will be seeing repercussions from. But I think, as I said, there could be also very positive effects of the acceleration, such as around the focus on maybe keeping supply chains more local, less dependence, and also and focusing on governance as well as renewable energy. So a lot of positive things to come of it, and we'll watch with interest.
Yeah, and it was very much that final point. I just wanted to push in terms of the positives, in terms of not being as reliant on oil and gas as the real opportunity to invest in renewables. That's something we've been pushing as an authority. So hopefully we'll be in the vanguard for what people will follow.
You've got that across way around it, wasn't it?
Neil. Yeah, so just obviously listening to a little bit what you're saying, and I can, obviously I've got the experience you've got, but I'll say, when you look at it, and especially after a while, historically there's always been recessions, and you look at like where sort of the cost of living's at now and that, and you can't help but thinking, are we heading for a boom and bust sort of situation where, once people are struggling, we're seeing where we are, eventually does this lead to some sort of recession? And if that was the case, how are we positioned as a pension group for that, you know, because I think it would be unwise to take his eyes off the ball, sort of, or become like rabbits in headlights if that were to come down, you know, to come to us. So I'm just asking you, as that, is that something that is possible, that could be envisaged, that we could actually, if you want, sleepwalk into a recession, as it were, so...
Yeah, it's interesting. One of the points that we used to make after COVID was that COVID was kind of a K-shaped recovery. You know, the idea of the K-shape. So basically, the white collar were doing very well. They were working from home. They saw they were buying everything on Amazon, and they actually had more money in their pockets. And then it was the service workers who were out of job, and they may have had a pandemic payment, but they were struggling. You know, they were getting more sick, and it just was very much not being evenly felt. And this whole inequality has been an issue for some time. I would also suggest that unfortunately some of these energy price rises are going to have the same effect. It's K-shaped. It's a doubling of an energy bill is going to have a lot more effect on a lower earning worker than it will on someone who's, you know, yeah, it's double, but it was only a small percentage of their salary anyway. So I think we won't have a widespread impact of these rising prices, but it will dent consumer expenditure for sure. But as to whether we're likely to get into a recession, I think we've seen the governments and central banks much more willing to intervene early and throw money at the situation to avoid that. Some indications around that the desire for labour, some of these shifts we mentioned towards renewable, they will actually cause a lot of will stimulate investment in some areas. So we're certainly watching for that. The other thing that's different about, say, 2008 is the banks are in very rude health. Apart from maybe some exposure to Russia and their stock price falling as a result, they're not in any way exposed like they were in 2008. They're not overextended. And when the financial institutions are in place, that tends to shore up just the confidence in the system, the infrastructure, and perhaps won't cause that kind of cascade of effects that we saw in 2008. So we're definitely watching for it. Unfortunately, I'm feeling it's not going to be evenly felt this recession.
Thank you for that.
Do you want to come back? You okay with it?
No, thank you for that.
Just very briefly, this is all assumes that the central banks are on top of all this situation. And I mean, as Ethan said, I agree with everything she said. The risk at the moment is higher than it's been for a long time, even if it's still quite small, that the central banks are not going to talk about everything. They take too long to raise interest rates, inflation becomes embedded, and it becomes an issue going forward, and that does lead to a recession in the end, a global recession. I'm not suggesting that's the base case, but we have to keep an eye on that.
David.
Thank you, Chair. The item that interests me is this 5% on the local for the levelling up. For me, local isn't UK. Local is South Yorkshire, and obviously I want more investment in South Yorkshire than just 5%. So I'd be keen for more of that to happen. Also on page 49, it's number 5 at the top. It says a further extensive consultation can be expected in the...
Oh, sorry. Typo. Summer.
In the summer.
Summer.
Chair, I'd come in on that. This is, of course, civil service summer, which runs until Christmas. And, you know, I was on a call with civil servants yesterday talking about this, and they weren't committing to any sort of date. What we're asked to do is produce our own plan for how we're going to address this, and clearly members' views will have an influence on the plan that we come up with. My personal view is that if you are going to have a levelling up plan about how you're going to invest in levelling up, you actually need to start with what's in the white paper about the 6 capitals and the objectives that the white paper is seeking to deliver. Find objectives within there that are and targets that within there that are investable, and then construct a sensible portfolio around that. Some of that will be the genuinely local, so in South Yorkshire, but there's only a finite capacity for South Yorkshire to absorb certain types of investment. And there are certain types of investment where there isn't enough in South Yorkshire that needs to be made, but if you invest on a UK-wide basis, there's enough investment for us to make a decent return. So there'll be a combination of things that are genuinely local, some of which we do already, and things that achieve a wider set of impacts in terms of those levelling up targets, some of which will be felt in South Yorkshire, but which will be we'll be investing in funds, for example, that invest across the UK. So there's a fund that's raising money at the moment that we are looking at that targets investments in facilities for victims of domestic violence. Now, the number of individual facilities of that sort you need in South Yorkshire doesn't amount to enough for us to invest in. But if you gross that up across the country, including South Yorkshire, you get what you get something that's actually worth us investing in and making a return from. So I think there'll be a series of discussions and debates about how we construct that portfolio so that there's balance within it and we're not concentrating too much in any particular area, but the need to invest in our place is something that's we're aware of and would be central to what we do, because we already do it. We want to capitalise on it. But there's only so much of it we can do. How much so much is we haven't tested yet, so we need to do some more work on that. But it needs to be a policy and priorities led process in the first instance, and then you find the investments that meet the policies and priorities. And a lot of that relates to some of the things we're talking about in the report on impact later on the agenda.
Yeah, I agree, and I realise we're part of a global system here, and South Yorkshire is included in that. But there are new and emerging technologies that we should be investing in to keep that money within South Yorkshire, get the skills, get the jobs as well. So that's where I'm coming from.
How we do that is something we need to be quite careful about, is we do not have the capacity and resources to invest directly in a business in Doncaster that's really great at doing the next thing that's going to support the Green Revolution. So what we need to do is find fund managers we can work with who will be doing that sort of thing on a relatively geographically targeted basis. And the geographical target for a fund like that might not be South Yorkshire alone, unlikely to be, but will be South Yorkshire. It might be Yorkshire and the Humber. Then you think of a lot of, particularly there's quite a lot of green technology businesses across Yorkshire and the Humber. And we've got various private equity managers knocking on our door, trying to get us to spend money with them on stuff which we don't have capacity for at the moment. So.
Yeah, thank you, Adrian. Thank you, George.
Thank you. Gary?
Yeah, thanks, George. It's just on what David said, and a few people, since I've been on, everybody's saying about investing in local, and George, you mentioned about policy and things. I just wanted, can we set a working group up, a few members who's interested, and big external funders, people who are saying what could work with us to invest?
Well, I don't think it would be appropriate to set up a funding group, a working group that was talking to investment managers directly.
Oh, no,
I think yes, in terms of how we devise our plan and our policy and our framework, I think a member working group to support that process would actually be quite helpful. We're not at the stage yet of actually sitting down and working out what it is we're going to write, but certainly when we get to that stage, which I would imagine might be in the autumn sometime, we can look to set something of that sort up.
I saw a few officers nodding around the room and smiling, and that's reassuring, because it's not that I want to sit down with that's your job to go and actually do that, but I think it's our job as members to push that forward into a policy. So that'd be good. Thanks, Dave.
Any other comments, please? Anything? Colleague? Carl? If not, David, thank you very much. And Rob for George. This is very interesting, and Well, it's, let's see what the future holds in the next coming months to weeks, okay? The next agenda item I've got here is the quarterly report that is on pages 51 to 72. It's Sharon, I believe Sharon, you're going to bring Martin as well. So Sharon, the floor is yours.
Thank you. Fund valuation at the end of December was 10.8 billion. Obviously, we had the conflict between Ukraine and Russia, which impacted all valuations, of all markets. The low point, the valuation fell to about 10.3, but it's around 10.4 billion at the moment. During that last quarter, there were three significant asset allocation decisions. The largest was the transition of our high yield and emerging market bonds into the new Border to Coast multi-asset credit fund. This happened in October. As well as the bonds that we held, we also added £47.5 million in cash, which took us towards a neutral weighting within our benchmark. To fund that, we actually sold down some of the legacy index-linked gilts that we were still holding, that we haven't transferred to Border to Coast. The other transactions during that quarter were in line with the strategic property plan that we had. We were selling some of the peripheral retail and office properties. And then the final thing was we had a significant drawdown into the alternative funds, which I think I mentioned to you last quarter that we were expecting that we would have that. So there was quite a lot of money drawn down. And this actually means that when we're looking at the different asset categories, we only have one category that's outside its tactical range. I think last quarter we had two. The one that's outside the range is private equity, and that's because we've continued to see an uplift in valuation of these funds. And although we had a net realisation of just under 20 million during the quarter, our actual weighting in that category has actually increased. You can see on the various charts that are in there the net investment over the last year, and it's much the same story. We've had reduction in listed equities and move into the alternative categories. Looking at page 58, you can see the performance against our benchmark. For the quarter, we had a positive performance of 4.1% against an expected return of 3.7%. Most categories outperformed. The only areas that underperformed that during the quarter were property and also bonds, and that was due to the transition that I mentioned. Which was less than 0.1% in total, but it did have a slightly negative impact on performance. And I think moving on from the quarterly performance, the positive news is that fund has actually outperformed over longer periods. So you can see the charts of the 1 and 3 year, but if you've got room, it would also be the same picture over the 5 and 10 year periods. I mean, the 10-year figures now actually 9.7% per annum in effect. Against a benchmark of 9.2, and that is a really strong return over that period. It used to be around the 8% level, so there's been the last few years have had a big impact of those longer term numbers. There is a chart there that shows the performance of the funds managed by Border to Coast, and you can see for the quarter that UK equities underperformed. That was mainly due to stock selection in materials and industrials and a fairly conservative position against a strong market backdrop. I'm not going to speak too much about that because we've got Mark Lyon here from Border to Coast, but he's going to give you more details on the Border to Coast funds. I think the positive thing there is you can see the longer-term picture since inception, and most of the only fund that's actually underperformed has been emerging markets, but we've mentioned that in the past, and they have introduced new external managers there, and the performance has started to pick up. Moving on, you can see the funding level there, but this is fairly strong and a fairly decent position. You must point out this is done on a roll forward basis, so it's actually using the 2019 valuation assumptions and just rolling them forward. It's not taking account of any movements that there might have been. So I presume that that's the figure at the year end, what they could do with the valuation. One of the things that I just wanted to point out on here this is the time of the year when we actually make commitments to the border to coast alternative asset classes. And you can see from page 64, one of the new things that they are doing is launching a Climate Opportunities Fund. This is a fund that we're really interested in. Obviously, we've got a net zero target, so we're looking for anything that can improve our position in this. This fund, 100% of the fund will be climate. It's not going to be carbon neutral. It's going to be carbon and climate aware, but it will help us in our decarbonising our overall portfolio. The investments in this fund are expected to be mainly infrastructure or private equity, although if the private debt opportunities come up, they will take them. I think one thing to point out is these funds are probably going to be more niche than the funds that they would look at in the main private equity classes. And the fund size is expected to be smaller. And the other difference in this fund as well is to the other alternative asset classes, we make an annual commitment. This fund is going to be a 3-year fund. So we make a commitment now, and it will be drawn down over the 3-year period. It will look to invest in 6 sectors across the will be clean energy, transport, agriculture, technology, industry, and sequestration. And it will look at assets in different, will be operating assets, so ones that will probably have a slightly lower return, but then they will also look at the developing assets and new technologies as well that should give a higher return than those assets. But as I say, the broad aim of that is to construct a portfolio which will have low carbon emissions. So it was something that we were looking very keenly at. One of the things is we haven't actually got an allocation within our benchmark at the moment. So what we've looked to do is we're accommodating it within our alternatives asset classes. So we looked at the position of our list of portfolios, and as of December, we had around 250 million in fossil fuels, and we wanted to counter that by investing that amount of money into this fund. Now, Border to Coast have got a capacity side on this particular fund that they didn't think they could go over. There has been a lot of interest across all 11 partner funds, so everyone has been scaled back a little. Our commitment that we've agreed is 245 million, but that will cover our exposure, because since the year end we've actually taken money out of some of the listed funds. Our equities, UK equities and overseas equities, so our exposure to fossil fuels will have come down. So that is a positive thing. We are doing something to counter our current exposure. On page 67, it just shows you, if we hadn't got the climate opportunity funds, what it would have been looking to put into each of those 3 areas. But obviously, I'm adjusting for the climate opportunities fund. So those are the commitments that we're going to be putting forward to Border to Coast. Ethan's already, touched on a lot of the outlook and everything that's happening at the moment. As I've said, we've also already cut our UK equity exposure by 10 million. We cut our overseas equities by £40 million to put into a listed alternatives fund. But we also took another further 20 million out because we had a lot of drawdowns into the alternative funds that I mentioned earlier in the presentation. I think the positive thing is, yes, there are a lot of difficulties now in looking at what we're expecting from the future and everything. But I think the good thing to note is, due to the diversification of the asset mix that we have, the fund at the worst point only fell by 4.5%. As Ethan said, we have got assets that actually benefit from inflation, our property assets and a lot of the infrastructure, which are the returns are linked to inflation. So they've held up well. As Ethan said, in the last 2 days, well, over the last few months, the dilemma for central banks is the need to combat inflation, but obviously with everything that's going on, they don't want to dampen growth too much. In the last 2 days, we've seen, as Ethan said, the Fed raised the rates for the first time yesterday, and also announced that there will be 6 further rate hikes this year. But I think the comforting things for investors was that they said that that should not impinge on the growth of the US economy, that they didn't think it would slip into a recession, and it was obviously taken very well. There was a bounce in markets on that announcement. And then, as Ethan said as well, one of the other things that's been the China market had a very strong rebound over the last 2 days because their financial policy body actually came out and made a statement to say they would ensure that there would be a stability in the capital markets and that they would also support their overseas listings, because there's been a lot of discussion about whether the ADRs that are listed in the US might have to delist and what would happen, to those companies. But there was a general feeling that there's some kind of agreement being had between the Chinese and the US, over the last 2 days, 10% and 7% move. That's strong. It's stronger than we've seen in years. Obviously, today we are expecting the UK to actually tighten policy again. We've had 2 rises. This will be the 3rd consecutive rise. And the ECB announced last week as well that it would actually end its bond buying programme that they've had in place over the last few years. I think the news there does come up a growing concern that the Eurozone could be impacted on it, because obviously they have a much closer connection to Russia and for their gas and everything. But the ECB said, did add that it stands ready to revisit any decision if the outlook changes. I think that overall that was taken quite well by the markets. Don't know whether that positive move will continue or not, but I think the one good thing is we've got a diverse asset mix, and so yes, some things may fall, but we would hopefully have some asset classes that would still manage to perform quite well. That's all I want to say at the moment. Mark's going to give a presentation on the approach to close topics. I don't know if anyone has any questions.
Any questions? No. Is Mark going to talk in detail about climate opportunities?
Mark will cover climate opportunities as well as the performance.
Can I just ask on that before Mark comes in then? Just in terms of asset allocation,
yes.
In terms of how we're going to report the climate opportunities fund in future in terms of the asset allocation, because the first thing we're taught as members is diversification. So clearly we've now got a very diversified portfolio, but it's understanding on each of the titles what's in which one, and clearly when we drew up the asset allocation we didn't have climate opportunities.
I will have a separate line within alternatives that will show that, so it'll show how quickly it is drawing down. As I say, at the moment we haven't got an LP. I mean, we're hoping that perhaps when we take the strategy review there will be a set allocation within that, but it's not something I have, so I've got to work within the parameters that you have.
Okay, Andrew? Yeah. Right, Mark, are you okay, ready to go? Okay.
Morning, everyone. Thank you for inviting me to your very nice offices. So I'm going to do a whistle-stop tour of what we manage on your behalf. Just go to the next slide. It's in my best Chris Whitty. If we just go on to the next one, please. So these are the investments you have with Border to Coast. Top part of the listed equities and fixed income, and then below are the commitments you've made to our private markets strategy. So just a quick kind of summary there. So go into the individual funds. Just go on to the next slide, please. Thank you. So as you can see, so inception today, ITD, that's since we launched back in July 18. So we're outperforming the benchmark over the long term. We're just slightly behind the target, which is 1% ahead of the benchmark. As you'll see, that performance in more recent periods, so last year was a bit more challenging. That was around adverse stock selection in materials. That was really down to our underweight position in Glencore. We struggled with Glencore historically because of their governance issues. We've got more comfortable with their recent management changes, but we still have an underweight position. Glencore was a very strong performing company last year, so we suffered as a result. We're also relatively conservatively positioned, and in a rising market such as that, it's not surprising to see that we've not been able to necessarily keep track with that. Pleased to see that more recently, so quarter one is actually just January, that the performance is more in line with the benchmark. We have increased our exposure to some smaller companies where we'd had an underweight position which was hurting us, and then we've also increased our exposure to what we would call quality cyclicals. So there's been quite a strong bounce in a kind of post-COVID recovery of some of the stocks that have been really hurt. We don't tend to invest in those, but where we do invest in those, where we feel there's some long-term growth, even if their business model is more cyclical than others. So we've increased our exposure there, which has kind of softened our relative performance to the benchmark. We've just gone to the next slide, please. And apologies, quite a lot on here, but really what I want to focus on is the blue bars. So part of our investment philosophy is that we think stock selection is the key driver for long-term returns, and anything above the line on the blue bar is where we've added through stock selection decisions. So as you can see, for the first 2.5 years since launch, we had some very strong stock selection decisions, and in the last year, that's what's caused our underperformance. We've mentioned the underweight to Glencore. We also have exposure to specialist collective vehicles, which gives us some sector exposure we don't think we can necessarily get directly through companies, and that's in environmental companies and also specialist healthcare collectives as well. They performed very, very strongly up to last year, and then there's been an element of those who've retraced some of that outperformance, so that's caused a bit of a headwind. Just going on to overseas developed, what I'm really pleased to see here is that we're outperforming not just the benchmark but also the target over the long term, and it's really, really consistent performance. The way we constructed this, we had 4 individual portfolios which come together to make the sub-fund. So we have US, Europe, Pacific and Japan, and each one of those portfolios is outperforming. 3 of them are outperforming the target, and the other one is outperforming the benchmark and is relatively close to target. Just going on to the next slide, and again the blue bars are the stock selection. As you can see, other than a dip when we first launched, really strong stock selection returns through the life of the fund. And if you go on to the next slide, apologies, there's quite a lot on here, but hopefully we can kind of focus on the 2 bits in red. So on the right hand side you've got the performance of each of the portfolios, so it shows that each one have outperformed their benchmark and 3 have outperformed the target. The tracking error column is we've made a conscious effort to increase the risk profile of the fund. So the tracking error is a measure of how much your portfolio varies relative to the benchmark. So the higher the tracking error, the more risk you are taking. The numbers have increased, but it's safe to say these are very low tracking error numbers when you compare them to other asset managers, particularly our external managers. But what we've done is made a real conscious effort to increase that risk profile for each of the individual portfolios. And we've done that in 2 ways. You'll notice on the holdings column we've reduced the number of holdings, so we've taken out that kind of tail of stocks that were not necessarily contributing significantly to performance. So we've rationalised the portfolio to a large extent. We're also taking slightly more relative positions, so larger overweights where we've got more conviction and larger underweights where we don't. So what that has achieved is that the individual portfolio tracking errors have in some cases doubled. But what you'll notice is that the sub-fund as a whole, it hasn't gone up by as much. And if you go on to the next slide, I can show kind of how this works. So on your right hand side, you've got the correlations of the individual benchmarks that we manage to. So you get an element of diversification by putting 4 regions together into a sub-fund, because when the US is outperforming, Japan may not be performing as well. When you then go on to the left hand side, what we're able to do through our portfolios is you'll see that when our US fund is outperforming, our European fund and our Japanese fund may not be outperforming. So what you're doing is you're kind of suppressing the overall risk at the sub-fund level. So that gives you that really nice, gentle outperformance on a regular basis. And it's something we probably struggled to articulate originally when we designed this, but this is kind of what we're trying to get across, is that you can have a relatively strong performing sub-fund with relatively low risk, because each of your individual portfolios are contributing something to that return profile. I think that might be it for overseas development. Apologies, I'm rattling through this at pace, so please ask any questions. If we go on to the next slide. So emerging markets has been more challenging from launch, and we took the decision to restructure it last year to add 2 China specialist managers. I think there was a recognition that long term, because China was becoming so much bigger and more influential, and the number of stocks, Chinese stocks in the benchmark was becoming, there was a significant increase. The challenge for us to do that with one person in Leeds is quite high. So we felt blending 2 China specialist managers with local presence and local knowledge would be appropriate. We actually did outperform in 2021, and perversely, all that outperformance came in the first quarter before we'd restructured, which is just typical. And that was really, we'd underperformed in the run-up to the start of 21 because we didn't have significant exposure to the large cap technology stocks, which were absolutely going great guns. There then came the kind of political and regulatory backlash against some of those companies, and they underperformed throughout 2021. So we had some benefit in the first part of the year of not having exposure there. But if you go on to the next slide, we'll show you that the performance since we restructured it back in April. So we're slightly behind benchmark. I think this is the telling bit there, is that Fountain Cap, they have, their exposure is very different to what you get from other China managers. So their focus is very much on domestic stocks. They have less exposure to the large cap tech stocks, which have suffered during that government clampdown to the likes of Alibaba or Tencent. So they've significantly outperformed by having exposure to more local Chinese stocks. UBS, that has more exposure to these to the large cap tech stocks, have performed in line with the benchmark. And then the internal fund, which manages the emerging market ex-China, has struggled with performance in that period. And it's not surprising. We have no weight position in Russia, and I'm more than happy to go into more details to why we felt that was suitable, given recent events. We also had exposure to a South African company called Naspers, whose biggest holding is Tencent, which is a Chinese tech stock, and that obviously suffered in the clampdown on China technology. We also had an underweight to the Middle East, and because of energy prices being so strong in 21, we underperformed by not having as much exposure there. What I'm pleased to see, although it's still been exceptionally volatile, performance is improving on the internal fund. We have had a change in portfolio manager, not as a result of the historic performance, but our emerging market portfolio manager left. We brought in someone else who's got 10, 15 years experience of managing emerging market equities for Aviva, exceptionally strong. I'm really, really pleased that we were able to recruit him. I'm going to be working damn hard to keep him. Go on to the next slide, unless there are any questions on emerging markets, or if I can take them at the end, happy to do either way. But if we go into the MAC fund, so this has been going for 3 months, so there's not a lot we can really derive from that. We also have a primary benchmark, which is a cash plus benchmark. So when markets are weak, we will naturally underperform that. So you can't really look at the cash plus benchmark on short periods, which is why we assess it over a rolling 5-year period. But what we can do is each manager has secondary benchmarks. So that is the universe that they're selecting the investments from, and so we're assessing them against that. And as you can see, from Bearings down to Wellington, they're broadly in line with the benchmark, slightly up, slightly down. Ashmore are underperforming, and then the internal Border to Coast portfolio is outperforming. On Ashmore, the reasons for the underperformance there is that their benchmark is 2/3 government bonds denominated in local currencies, and 1/3 emerging market corporate bonds denominated in what are called hard currencies, so typically dollar, sometimes euro. Ashmore have had an overweight position in those corporate bonds, and those corporate bonds are more sensitive to interest rate movements. And because you've had an inflationary environment and the expectation that bond yields, the interest rates are going to go up, has increased bond yields, and so they have suffered as a result of that overweight position. But it's relatively minimal relative to the benchmark. When I look at Border to Coast and the outperformance there, that is driven by an underweight position in Russia, not having anything in Belarus, which clearly current circumstances have benefited very well, and also an underweight to Philippines. So as I say, very, very early days. I think we're broadly comfortable with performance to date, certainly in relative terms, but we appreciate that against a cash plus benchmark, when markets are falling, we will naturally underperform. Just onto the next slide, which gives a bit more details how we kind of design the portfolio. So you've got those managers with the third column, the strategic weight. So that's the neutral weight to each of those managers. And then to the left-hand side of that is the current weight. So we have an asset allocation committee which debates and reviews macroeconomic indicators and then comes up with a decision as to whether they want to tilt the weighting to each of the portfolios. So as you can see, the rationale for having a greater weight to Ashmore on the emerging market local portfolio was that the emerging market currencies were very cheap relative to their historical levels, and the credit quality on local emerging market debt is higher than on hard currency debt. So a combination of valuation and quality led us to want an overweight position there. And then on the other side, high yield, credit spreads were very narrow in high yield, and therefore the valuations didn't look particularly attractive, which we felt warranted an underweight position. And we have those asset allocation committee meetings on a quarterly basis. I think in the vast majority of occasions there'll be no change, but where there are, where there has been significant changes in market conditions, there's the flexibility there to change the kind of introduce an element of tactical asset allocation to take advantage of that. And then on to the next slide, which is investment grade credit. So again, since inception, well ahead of the benchmark and well ahead of the target. So the target return 0.6 per annum, and we're currently running at 1.5% per annum. And that's strong performance from all three of our managers. And again, this is one fund that we've blended together different styles. So RLAM will typically focus on bonds that have less liquidity, so they get an additional return premium for holding it over the long term. M&G are more value orientated, and Insight are a little bit more benchmark aware. And so when you blend those all together, I mean, they've all performed very, very well individually, but when you blend them together, you get that nice, smooth outperformance over time. And then moving on to sterling index-linked bonds, and again, the target for this one. This is a very low risk, low return fund. So the target for this is the benchmark plus 20 basis points, to 0.2%, and we're currently from inception to date about 0.5% above the benchmark, so significantly above the target. And the way we manage index-linked bonds. We're generally neutral on duration, so we're not necessarily trying to time when we think yields will move or interest rates increase or whatever. Where we look to get our return is by owning corporate bonds, which have a index-linked corporate bonds, which have a return premium. The movements in that premium, so when corporate bonds are more attractive, the spread tends to narrow and the return goes up. And also what we call curve positioning. So standard yield curve will go from that to that, and then it could move depending on where you think short-term interest rates are going to be versus long-term rates. So we take a view on where we think the yield curve will move to. Since inception, most of the outperformance has come from a compression in corporate bond spreads, and that move in the yield curve has made a modest addition. I think that's it on the portfolios we managed today. I was going to go on to climate opportunities next, but whether we want to ask any questions on what we currently manage for you before going on to climate ops.
I think market would be. I mean, we will circulate the slides afterwards for members, but I think market might be helpful for members to explain a bit more about the logic of the different positioning on Russia, where you were overweight equities but underweight credit.
Yeah, no, happy to do that. So,
I mean, overall we were slightly underweight. But,
yes, and I think it's fair to say that Russia is either the 5th or the 6th largest market in the emerging market index, or was, and therefore it was a meaningful allocation, or we would need to have a meaningful decision not to invest in Russia in normal circumstances. Our view on Russia, we got exposure through we had 6 stocks across 2 different themes. The first theme was that Russia really suffered during COVID, so the economy went into a deep recession. It was starting to come out of that, and it was performing very, very strongly. So the macroeconomic data was really, really strong. We wanted to play that in 2 ways. So we played it through a company called Magnete, which is a retailer, effectively, and the idea was there that there would be more disposable income, consumers would start to spend more, and the retailer would benefit from that. The other area was in Sberbank, which is the leading Russian bank, or was. We felt that was a very well managed bank, and again that would benefit from a strong economic recovery, increasing lending opportunities to consumers and things like that. The other aspect was to get exposure to commodities. So through the other 4 companies we had exposure to oil, gas, nickel, palladium, and copper and other peripheral metals. So the reason behind that was that we felt the commodity prices would remain very strong as we come into a kind of a global post-COVID recovery. We also wanted to have exposure to those metals which we think are going to be key to decarbonise the global economy over the long term. So the use of nickel and palladium in electric vehicles, and the use of copper for renewable energy assets, wind turbines, solar panels, etc. So that was our view there, and then balanced against that. So the question would be, well, could you get that exposure elsewhere rather than having to do it through Russia? And for the commodity companies, yes, we could, but the Russian commodity plays have very, very low cost resources, and you typically find that those companies that have a low down on the cost curve will typically generate more greater returns, because you have a global price and then, I guess, local costs. So because their costs were so much lower, their profitability would be higher. They also, particularly in the case of nickel, had the highest grade nickel ore globally available. So it was quality, and it was the cost of extracting it were the key drivers for that. We could have had exposure to oil and gas through the Middle East, but then I guess you've got other governance concerns around that, and the valuations didn't really support that. And then just on valuations, the Russian market at the time, so coming towards the end of 21, was valued at 6 times earnings. The emerging markets in total was valued at 14 times earnings. So it was a huge valuation discrepancy, which we felt on balance reflected the risks around governance, the lack of rule of law, at the time, the increasing tensions around Ukraine, but nothing really concrete. And in hindsight, clearly we shouldn't have had an exposure to Russia, but we felt it was the key risks were kind of priced in to a large extent. Things have obviously now changed. Fixed income. the Russian government has an exceptionally strong balance sheet because post the Crimea invasion and the sanctions that were placed on them, then they wanted to become self-sufficient. So Russia considered, again, prior to the conflict, to have a fantastic credit quality with a very low probability of default. We looked at that and we recognised that, and that was a positive. But then we looked at the valuation of the bonds and we thought, well, it kind of reflects that strength. And then on the other side, you've got lots of governance concerns, AML financial crime risk, and the potential for an increase in sanctions, and this is pre-Ukraine tensions. So I guess it's we looked at it in the same way, and on equities we felt it was reflected in the valuation. In fixed income we didn't think it was, and that's how we were positioned. Again, in hindsight we would have been positioned very differently. Happy to take
2020 hindsight's wonderful. But
so with that exposure that we've got to Russia and the sanctions that have been imposed, and we can't pull that money out, how do you then reflect that within the balance sheet? Because the actual price of the bond before we brought sanctions in. So
yeah, so the prices are effectively zero now. So you can't trade them because they're subject to sanctions, and the brokers that we would deal with are not able to trade in those bonds. So they're now, because they're priced at zero, I suppose what you've got is option value. So if there is a resolution, hopefully quickly, to the issue, and then there may be a rebound, we've then got a decision as to do we want to have exposure to Russia long term, and then that becomes partly geopolitical, but partly what are our investors' views on long-term exposure to that kind of regime, and we are working very closely to both with our board but also with the joint committee and the officers to try and understand where we want to be positioned longer term in Russia. But at the moment we can't trade them, they're priced at zero, so they kind of just sat there, and we will make a decision at some point in the future when we have a bit more clarity.
Just to follow up that point. So you're saying everything at the moment is frozen and we can't trade it, and you're saying some point in the future. I mean, we're back to trying to predict the events in the next few weeks. But let's be positive and say there is a diplomatic solution in the next few weeks. What is the timescale of your decision point in regards to everybody else's decision point? Because one assumes other things happen before trading, in terms of there'll be a statement from governments about which assets get unfrozen when limited trading happens, and then what is the new relationship with Russia going to be like in terms of trading?
And we'll just continue to monitor it. So we have daily calls now on the issue around what are our brokers saying, what are the governments saying, have there been any new sanctions which impact on us? And on that, we have, I guess we have three controls in place to prevent inadvertently adding exposure to Russia. The first is that the portfolio managers are aware of what our position is, so they will not be putting trades on. If for whatever reason somebody did, we have automatic compliance controls which would stop that, and then the brokers we deal with cannot accept those trades. So we've got multiple points where it should prevent any inadvertent increase in exposure. And then we have to think, what do we want to do longer term? Russia has been taken out of the benchmarks, so it's no longer a benchmark issue. So I mentioned at the start Russia was quite a large benchmark weight. If it's no longer a benchmark weight, we have more optionality to potentially not invest in it. The risk comes, we have a short-term resolution, we sell our holdings at still a depressed price. Russia is then welcomed back into the international fold, goes back into the benchmark, and we start buying the assets at a much higher price. And that's where we've got that balance between fiduciary duty and our other considerations. So it's not easy, but we are monitoring it.
Okay, Andrew? Yeah. Gary?
Yeah, so what you're saying is just let's leave it and see, really.
At the moment, because we can't do anything anyway.
No, understand that. It's just how much has Board to course actually got invested in the, and how much percentage is actually got from South Yorkshire pensions.
Can I get back to we do have the figures, but I don't want to say them off the top of my head. It was in the communication.
Yeah, I mean, in terms of the proportion, it's about 0.3% of our fund is invested. Certainly, the majority of the money invested in the equity, the emerging market equities, will be ours, because we're the largest investor in the emerging market equity fund, and it's a much smaller proportion of the credit, because we're one of 10 or 11. I can't remember. Is it 10 or 11?
I think it's
microphone.
I think it's all 11. Yeah.
No, so can I just pick up Gary's point? I mean, the letter we've had from the Secretary of State implied that we could take stronger action in terms of disinvestment. Is he not quite saying that? Is he saying that we need to monitor the situation and do things when the situation becomes clearer?
I think it would be valid to interpret the Secretary of State's letter as a political statement rather than an investment statement.
Quite shocking. I mean, I thought he was trying to tell us that there was going to be a long-term repositioning of financial stuff.
If you look at it in the context of the debate about the generic amendment and disclosure, boycotts and sanctions bill, I think what the Secretary of State is saying that deciding to disinvest because we don't like the Russian government would be acceptable within the context of disclosure, boycotts and sanctions, whereas choosing to do that in another geographic context would not be acceptable. So he's giving a steer on the line of the direction of UK foreign and defence policy and what's acceptable within that, I suspect.
I note the information and we'll come back to it in a few months.
Yeah, yes. I mean, there is a decision. There is a decision to make. Mark doesn't know this at the moment, but part of the informal discussion after lunch is focused on geopolitical risk. So, for me to get a steer from members about how you would want to address that going forward, and that isn't necessarily about Russia, although clearly Russia prompts the discussion. But if you think of the countries we are invested in emerging markets, China, Taiwan, countries in the Middle East, although underexposed to them, you know, there is a debate to be had about whether the risks of investing in those countries are risks we want to accept, or we want to do we want to change the weight we give to those risks within our portfolio, because we have quite a significant exposure to emerging markets, particularly compared to some of our peers, and there are good reasons why we've done that, and over a long period that's served as well, but time to think about it, and we're about to embark on a strategy review, so feeding those sorts of thoughts into the strategy review process is helpful. What the results of that discussion will be, no idea, but that's why we're having it.
Any other members? One last question. Can I ask you one, Mark, about China and emerging markets in there? They're a very positive forward-looking country at the moment, but what account do we take, if any, of the human rights issue in China?
It's part of the assessment of the kind of the ESG ESG process or framework that we include in our investment process. So we do that through our engagement with companies. We do that through our engagement with the external managers now with China. So we want to understand the company's approach, and we also want to understand the managers. How are you challenging the companies on things around human rights, forced labour, all those kind of things. You know, we are not in a position where we can influence the regime, clearly, but we can choose to invest in China in a way that perhaps means you're not as exposed to the regime. But it's one of a number of criteria that kind of we call country risk, for want of a better term, and you know, we don't formally say, well, this country is rated X, so therefore we'll have an allocation of Y. But when we do it internally, the portfolio managers think about that when they think about the weightings they want to companies, and the external managers will have different ways as to how they incorporate country risk. But it is as George mentioned, emerging markets is fraught with those kind of risks, and it's sometimes quite difficult to manage.
It's not just China, it's the Middle East as well, that issue across there. Thank you, Mark. Any questions, colleagues?
Mark's just going to move on to talk about the climate.
Something hopefully which is a bit happier. So this is our new Climate Opportunities Fund, which is my baby, and I'm really looking forward to getting this money invested. So what we're looking to do here is deliver a relatively attractive return, 8% per annum, through a combination of income and growth, and it will have a specific focus on those investments that reduce carbon emissions and support the transition to low carbon economies over the long term. What we're asking the managers that we invest is they've got to clearly demonstrate and also, more importantly, report the carbon and transition impact, because what we're finding, particularly in private markets, is there's a lack of information around the impact. We're working with a number of industry groupings to hopefully improve the level of disclosure. And the fourth point is very important to us. We want to make sure that we're not investing with managers who are finessing it and potentially greenwashing their opportunities. So if we just go on to which I think is the final slide, as you can see, there's a huge amount of things we can do. The clean energy, which is what we're already doing in infrastructure, a third of our infrastructure portfolio is around renewable energy. But this is more about new development, next generation power grids to make them more efficient, the potential to invest in hydrogen, and the potential to make battery storage scalable, transport EVs, etc. Technology, there's a lot of climate tech or clean tech funds out there, which are able to improve energy efficiencies through management systems or tracking of emissions or modelling climate scenarios. Industry is an interesting one because this is why it's not low carbon from day one, because we understand that if we want to enable you to get as close to your net zero targets as possible, we're going to have to decarbonise the heavy carbon emitting industries. So you've got low carbon cement and steel in there, increased automation to reduce those carbon emissions. Those industries will still be relatively carbon heavy, but hopefully there will be a significant reduction in their carbon exposure. And then the two bits that don't, the first four could probably have been invested in through our other private market vehicles. The last two, not really. They don't really fit into those. And this is where sequestration through if we can crack carbon capture and storage technology on a scalable, relatively low cost basis, then great. Forestry clearly is an opportunity for us, and then kind of maybe going a bit wider than just pure climate reducing carbon emissions. It's more sustainable agriculture. So whether that be through better food production methods, using alternative proteins, and then obviously the impact on biodiversity and water management. So apologies if I sound a little bit evangelical there, but I'm really, really excited about this one. As Sharon mentioned, we've had to cap the fund. It's not something we wanted to do, but we wanted to make sure that we can get exposure to the smaller managers, the more niche strategies that are perhaps not scalable today, but we hope to be in the future. And we didn't want to dilute the returns from those types of managers by having such a big fund. So we originally thought the cap would be about 1 billion. The market is moving quite quickly, so we've revalidated that, and we're comfortable with 1.35 billion. So we've been able to increase the exposure. It still meant that we've had to scale everyone back fairly significantly, and I apologise for that.
Well, I mean, it's a function of success, Mark. I don't think you should apologise for that. But just to give an example of what Mark was talking about, in terms of these tend to be smaller funds. So as part of a top-up investment to what we've committed to Border to Coast in order to maintain, we make a small number of investments in alternatives outside of Border to Coast in order to keep the profile of our investments across time right. So we've just invested, or agreed to invest in a clean growth fund, which has a fund value of 101 million. Now, the funds in Mark's main portfolios are raising 500 million plus.
Yeah.
So we're talking about much smaller niche products that we're investing in. So just to, I think I've tried
Any
the
questions, Chris? Mark? More questions, Mark? I've got one for Chris. Chris?
Just I read this paper. I was quite interested in the diagram in relation to clean energy transport. I'm aware in Germany, well, across Europe actually, but it seems to be driven by the Germans for the hydrogen-powered trains, which seems to be investments that seems to be coming on, and to increase the amount of not just hydrogen in heavy rail, but hydrogen-powered light rail as well, which would benefit this country enormously. And I'm just wondering if that's an area of investment that's been looked at within that hydrogen transport type bubbles.
Yeah, at the moment what we've looked at is more around the hydrogen technology as opposed to the application of that. So, but obviously aware that I think it's Hymans that have the hydrogen trains. Hydrogen is an interesting one because I'll probably get the wrong Japanese car company, but I think it was Toyota nailed their colours to hydrogen for cars, and it doesn't really work for cars, but it does work for, like say, light rail, heavy rail, and potentially lorries as well. So there is a place for hydrogen. Where you've got to temper it is that 20 years ago there was a lot of hype around hydrogen and lots of people lost a lot of money trying to invest in hydrogen technology. So whilst we're very excited about this, we've just got to make sure we do it in a sensible way, that we're not sacrificing returns for the positive climate impact.
Okay. Okay there, Chris?
Yes, thanks.
I've got Gary, then Andrew.
Yeah, that's it. I think we'll be using that as our working group. Can I just go back one slide and explain the fourth point on it about the greenwashing?
Yes. So there is a lot of focus from the FCA and other regulators around managers badging things as either ESG or climate aware when they're not necessarily are. So the EU brought in a classification system, which and it's Article 9. So Article 9 funds are funds that have been validated that they will make a material contribution to climate reduction. So we want to make sure that when we're doing our due diligence on managers, that they're just not badging a bog standard investment as a climate investment and get away from that kind of greenwashing. It's also, greenwashing has been they've been accused of doing that in their reporting as well, maybe embellishing the positive climate aspects of some of their investments. So it's something we're quite aware of, particularly because the FCA are very aware on how people classify the funds that they sell.
That's interesting. I just wondered, we're monitoring that, so you've covered that. Thank you.
Yeah, it's regulator. There's kind of industry standards as well, and then there's our sense check on top of that.
Okay, got it.
Yeah, thanks.
Andrew, then David.
Yeah, thanks, Chair. I was very excited about this. We talked about this first at your conference, October 2019, so 2.5 years, and really pleased. One of the differences between this fund and some of the other funds that Border to Coast has launched is that it's been wide partner buy-in, whereas at other times it's been South Yorkshire driven it. This time we've been there, but everybody else has jumped. And I suppose the question in terms of this limiting of the cap to 1.35 billion, will there be a second round? Will that change in 2 or 3 years' time? Clearly, we always have to think about diversification and asset allocation. So, it's not the only. We clearly need to think about that. But I'm just concerned if we've all been restricted because for once it's not just been South Yorkshire, whatever, but it's been a large. Most of our funds have gone for it. So will there be a change in the next 2 or 3 years if it's successful?
Yeah, I suppose there's probably three drivers there. So we could deploy the capital quicker than we originally expected. So the 3 years was to give us time to make sure we gave you a balanced, diversified portfolio. It may be that we're able to deploy capital quicker, and therefore we could come back with a follow-on climate opportunities fund at an earlier time. The market itself may become much bigger, and we can relax that cap and get more comfortable with doing that. Or thirdly, our traditional private market strategies may just become climate strategies because the market moves that way. So I think we've got a few levers to pull there. The reason we'd launched climate ops now is because we didn't think the other strategies were there to be able to. You'd have a climate opportunity having to be compared against a non-climate opportunity, whereas with climate opportunities, all you are getting is climate positive exposure. So we wanted to, I guess, give it a chance that we'd be able to get a nice diversified portfolio. But I'm hoping we can come back and offer you something.
And when you say hoping to come back, do you mean in 2 years or 3 years or
yeah,
shorter than that?
In my mind, automatically, if the opportunity is still there, we'll come back after we've deployed this capital to see if partner funds want to have a follow-on vehicle from that. So that will be within 3 years. If we deploy it quicker, we can come back quicker. It still takes 6 to 12 months to design and launch a fund, even a follow-on fund, so it doesn't move as quickly as maybe you would like it to.
Thanks, Leandro. Can I just point out, colleagues, in your agenda out there, if you look at page 65, that is show there in your pack, so very helpful. I've got David, then Fran.
Yeah, thank you, Chair. It was just really following on from Gary's question about ESG greenwashing and your visibility for all the funds that you're investing in. Have you got trigger points within those funds that, and what's the reporting system that you put into yourself? Because it's a long-term investment, isn't it, potentially? But the consequence of a long-term investment, the damaging effect on the environment could have.
Yeah, so we've got an ESG framework that we incorporate in private markets, and we send out what's called a due diligence questionnaire. So we ask a number of questions of the manager before we commit to them about their approach, how they incorporate it in their process, how they do reporting, all that kind of thing. So that gives us comfort on those responses. We then score each of our managers. We've got a quite grandiose ESG scorecard, and if there are managers that we think don't necessarily meet the minimum, we might stop, no longer do due diligence and not invest with them and pass on that opportunity. And then part of our ongoing monitoring, which is typically on a quarterly basis, we want to understand whether there have been any ESG issues in the portfolio, whether they've had any changes to their process, new investments, has there been any kind of ESG angle that we need to be aware of. And then we send out an annual ESG questionnaire for them to answer as well, and we'll follow up with any other points. So we're pushing managers more and more on that because we're aware that ESG in private markets is not as advanced as it is in public markets. European infrastructure managers are very, very good. US venture capital managers can't spell ESG, frankly. And we have not invested with a venture capital manager, because they weren't prepared to improve their processes. On the other side, we selected a manager partly because they really wanted to work with us and improve their own credentials around that. Because it's not at the moment, but at some point in the future, it will become a reason not to invest with a manager if they haven't got certain basic standards around ESG.
Okay, Dave, Fran.
Yeah, I think it probably follows on again. I think it's like a really positive development. It's great to see your own enthusiasm for us as well. I just wanted to come to some of the points that were raised that I think in the email that probably most of us got from the fossil-free campaign. That was some of it was very much about doing some positive investment like this, but the other side of it was around disinvestment in the fossil fuel companies. And indeed, I know the kind of arguments we've had, discussions we've had around that was about how much we can influence by continuing to invest. But a lot of the points in that email was about the lack of engagement from those companies, and indeed greenwashing themselves. I think it talks about Shell in particular, so I wondered if you could comment on that and how this might sit alongside.
Yeah, I think because I'm for my sins, I'm also the investment lead on our net zero work. So I've been doing a lot of work on the implications of net zero and how we can change our processes to bring that in. And our position has always been, and it's been validated by all our partner funds, is that divestment is not necessarily exclusions, with the exception of tar sands and coal. We don't necessarily want to go down that route. We want to work and engage with companies to improve their performance and their behaviours. There will be certain companies where you know you can't make any progress, and that almost de facto becomes an exclusion because you know they're not going to improve. You could maybe argue our decision to divest from Exxon was based on that because they just weren't showing enough progress relative to other oil and gas companies. So as part of the net zero work that we're doing, we're going to have a targeted engagement on our top 25 carbon emitters to start with, and then we'll extend it over time. And really there, what we want to know is, what are your plans to decarbonise? Are they ambitious enough, but are they also credible enough? Can you get to that? Because it's all very well saying we're going to be carbon neutral by 2035, but if you can't show a path to getting there, we can't continue to invest with you on that basis. So personally not a fan of just reducing your exposure to fossil fuel companies, but very much a fan of trying to understand what their pathway is to get to net zero, or as close to net zero as their industry can permit. And then our job as portfolio managers and our external managers' job are, do we think they're credible? And if they're credible, great, because by 2035 they'll be carbon neutral and your portfolio will be carbon neutral. There's clearly touch points and trigger points along that route where they're either not meeting their targets, or the targets have become much more aggressive because of things that are going to happen over time with further reviews into the impact on climate. So it's thank you. So yeah, and it's really it's probably something I can't answer in 2 minutes here, but I'd love to have a broader conversation.
We want to use one of the seminar mornings later in the year around some of this stuff. So, and I think the way we do that will probably need to involve Mark and other external speakers to try and get a proper picture of it. So it's not a simple set of issues.
Fran, are you okay with that, Fran? Dave, Douglas.
Thank you. I used to work at a glassworks, so we used oil and now gas to fire the furnaces. Obviously, it's a heavy user of fuels. How are you invested into new generation fuels? So industries like that, cement, different industries can use fuels which are less corrosive to the atmosphere, and with glass it can be recycled, so and steel as well. So it's not greenwashing in that the energy is free, but it's a case of how can we encourage those industries to use different fuels to get the same product.
Yeah, and we've got low carbon fuels on transport, but it goes, I guess it's low carbon fuel input into industry as well. So that'll be where it's more the kind of venture growth managers that are looking at these new fuels. How can we use these in industry? How can we scale it up? It's not just on climate opportunities as well. We've got an exposure to Lafarge, who are looking at or have developed a low carbon cement where they effectively inject the carbon dioxide into the cement and it actually cures it and makes it stronger and effectively becomes a sequestration of carbon. That looks really interesting. It's ruinously expensive compared to normal cement and steel at the moment, but if we can get it scalable and get it cost competitive, in the same way that renewables 15-20 years ago were really, really expensive. They're now on parity with normal fossil fuel generation. So that what we effectively are is we're enabling, we're giving capital to enable that scale to come together. So there's going to be lots of really interesting things in there, and we're looking at a number of really good managers who are doing some quite interesting things. And just going back to my, we've just got to make sure we're not over enthusiastic and necessarily throw money at technology that might not work. So that's where our caution is on that, which is why we'll have a broadly spread, diversified exposure.
Okay. Any other questions? If not, Mark, thank you very much indeed.
Thank you very much.
It's been very enlightening. And Sharon as well, thank you. We look forward to seeing the rest of the slides. Right. Colleagues, the next agenda item is number 11, pages 73 to 92, and it's George.
Yeah, thank you, Chair. This is a relatively routine report. It's the annual update for two of the responsible investment policies. There is little, if any, change other than the addition of a pretty picture to the responsible investment policy. The policy has been updated to reflect the linkages to the border to coast policies and the way they've changed and other decisions that we made during the year, but there's no fundamental changes or changes of principle. Happy to take any questions.
Any questions?
Yeah, I was just going to ask if there was any significant admin costs attached to this, you know, that
there's not in terms of constructing these strategies and policies themselves. Clearly, we invest time in our work on responsible investment. We need to do more work because regulations are changing, so that mainly we need to do more work around climate reporting and so on. And there'll be a direct cost to some of the climate reporting as we'll have to commission external organisations to do work for us. There is, we may discuss it later in the private part of the meeting, there are resource issues that we face and that we need to address to make sure our efforts in this area and a number of others are sustainable in the longer term. At the moment, I'm spending a considerable proportion of my time doing that. That's fine, it's a priority for members of the authority. I should be spending time on it, but if I decided to go or fell under a bus, my replacement might not have the desire or aptitude to be able to do that. So we need to make that sustainable, and that's an issue we need to address, as I say, not just in this area but across the whole aspect of our work. But the demands in this area and the scale of activity in this area are rapidly increasing. I mean, Border to Coast are looking to, I think, add 3 additional people in the responsible investment team, and that's just in terms of the work they do on our behalf, some of which but we have a lot of responsibilities that don't pass to the pool under the way the rules are written. I mean, to exercise an effect.
Questions, comments, colleagues? Andrew?
Yes, I mean, I'll say that I welcome the priorities of the authority placing on these two areas. I think the challenge is what George has just said in terms of the regulations. Yeah, they say that we're responsible for this policy, but yeah, the reality is it's about what Border to Coast can achieve. So I'm still struggling with that in terms of when the public asks me questions and explaining what we've said. We have our investment principles, but then Border to Coast and invest the money. And I think my concern was just in terms of the language of these two policies. And clearly, you said that they're minor changes. And I have to say I've not done a track change, so I don't know all the changes. Some of it's updated. But I think it comes back to the decision we took to take IPCC quite seriously in terms of 2030, the net zero targets. And in terms of the way you word it, in terms of page 1991, it's almost as if you're saying that the industry position, the Border to Coast position in 2050 was what the world was accepting, and that we were out of step. But I would go further to say that we've taken this position about net zero by 2030 to drive change and to move to a low carbon economy, and that's where we're going to tilt our investments. And it's almost as if you're saying it is still a big risk, right? I think the risk of not doing it remains higher than the risk of trying to do it, and I'm just a little surprised at the way that's been framed.
I think as an officer, I need to, as Mark was doing, about cautioning you about not getting overexcited about things, I need to highlight the risks of non-achievement. When I've been talking to people from other organisations who've come along and said to me, how the heck are you going to do this? I've been very positive, because it's the authority's policy. We will seek to deliver the authority's policy. There is, and I have to be honest with members, a high risk that we won't achieve it at present. Now, some of that comes from what you talked about, Andrew, in terms of the sort of mismatch within the pooling process, in that our objective isn't fully aligned with everybody else's, but some of it comes from just a lack of opportunities to get us there in that time, potentially. But we'll, you've given me a kick up the backside and told me to get on and do 2030. Well, we'll do our damnedest to get to 2030.
And all I'm doing today is giving people another kick up the backside and saying we're absolutely determined to hit 2030, and we will do it, and we'll bring other people with us, and we will make a change.
Can I just emphasise again, though, this Chair, we never ever in our September meeting said we will try and get to it. What we said was, can we have a balanced approach in there and start the ball up, so in 10 years' time we could have a passageway or a pathway there that leads to a far better and bring in climate change policy over a 10-year period. That's what we said all the way through. Just to make that point. Any more questions, George? Please, on that one? No? If not, the recommendation is A, approve the following updated policy documents. 1, the authority's responsible investment policy at Appendix A, and the authority's climate change policy at Appendix B. Are we agreed? Agreed. Okay. The next generating college is generating 12, and it's the pages 93 to 114. There may be some discussion here, I hope there is. It's net zero action plan update. George, sure.
Thank you, Chair. 4 months ago, you approved the first set of actions to set us on the road to achieving net zero. This update to the action plan sets out what we've done and where we've completed the actions, and the next steps where we need to take them. We have made progress. We've worked with Florida to Coast to identify the Climate Opportunities Fund that you've just been talking about. This document also sets out some clearer views on how fast we will have to reduce emissions from some of the core portfolios if we're to meet 2030. To achieve those requires very, very significant increases in the rate of emissions reduction. And in order to be, coming back to the point I was making previously, to be clear to members, there is a discussion that we have to have about what this means for our investment beliefs and how we do investment. And we need to begin that discussion alongside this strategy review, and it will run for much longer than that. Now is particularly, given where we are in the time in the meeting, now is not the time to have it, but part of the idea of some of the informal sessions that we've grafting onto these meetings is to provide the space to have those conversations, because they're conversations that need to take place to develop policy and develop thinking, rather than in the context of the reforms debate, which is what we have in a meeting like this. Go back to Councillor Fisher's point about are there resource implications? Yes, there very clearly are resource implications here. We are going to need to pay an external organisation to generate all the measures and metrics we need, but that's going to be required by regulation within the next 12 months anyway. Border to Coast have procured a contract with a data provision firm, and we can hopefully piggyback on that for at least some of that. It would be nice to think that it was once you'd produced the metric for the UK equity portfolio, it was as easy as adding that to the metric for the overseas developed market portfolio, but it isn't. You need to do the adding together at a granular level to get the metrics that are required. So that, as demonstrated in the report, we have seen emissions reduce in the portfolios we measure in the last year. I mean, the emerging market equities portfolios 50% reduction. It's got a very significant reduction in absolute emissions over the last 12 months. Now, partly that's to do with the restructuring of the portfolio and the managers having more targeted portfolios, much narrower portfolios, and focusing on emissions as part of what they're doing. But that's not the only reason. All three of the portfolios have seen material reductions. So that's good news. But as of today, we are not on a path that will take us to 2030. We're on a path that probably is reducing faster than the path we were on 12 months ago. So that's progress. But as of yet, we're not where we need to be, and the risks remain. And since this report was written, the risks have changed. There are additional risks. Clearly, some of what some countries are proposing to do to reduce their dependence on Russian fossil fuels might be significantly unhelpful in the overall chase to net zero. If the Germans start burning more coal, that is not good news for anybody. But there's not so much we can do about that. We can deal with the things we can deal with, and we won't invest in. As Mark said, we don't invest in pure coal miners anyway. So those are all there. And I mean, the report is a very similar format to last year. Illustrates the progress, but also, as we have to do, highlights the risks that we face. And as I said before, we will strive to get to the 2030 goal. But we have to be honest about the likelihood of achievement.
Questions, comments, colleagues?
Can I make a comment?
Yes, Steve. Yes.
Just thank you for honesty. We've got to realise what the pension authorities is to do, and if that point in time isn't there to cope with the investment or taking over that investment in fossil fuels, it's not going to happen, because we've got to look after people it supports.
Team members, okay, next day. Andrew.
Yeah, no, I mean, I welcome this report and I welcome the progress. I mean, it's been, it's always been a journey. It is incredible, and we've always known in terms of measuring the baseline, that it's been easier in terms of UK equities and some of the alternatives. So it's still frustrating. You know, we've been having these reports for, say, 7 or 8 years, and we're still getting lines like lack of data. And every year I read a report and it says lack of data. At least we moved away from, you know, we started with UK equities lack of data. We're now onto the more difficult multi-asset credits lack of data. So you know, there is progress. And I think what this sets out is, as you say, a direction of travel, and it shows the challenges of the 2030. But all I would look at is the challenge of, you know, the winter we've just had in the UK, which is, you couldn't have imagined that 25 years ago, 30 years ago, and the changes in the Arctic and the Antarctic are, you know, phenomenal. And if we talk about you know, methane emissions from permafrost, the challenges for the world of not meeting these targets are huge. But you know, I accept the fiduciary responsibilities. Our job is to pay pensions, but it's also, as we move to a low carbon economy, we want to make sure that we've invested we've been part of that, and we've driven it. And we have the opportunity as a global investor that we don't have. And as Portico said earlier, we've been able, both on the tar sands, to make decisions about not investing. I really welcome the news about ExxonMobil, because I'm somebody who believes that you engage and you get companies to change their strategies, but there comes a point where engagement's not the only answer. I think what I want to see is understand, and what I've always wanted to see, right from when we talked about this 10, 12 years ago, was to say, what are the staging posts? Really impressive what George and Steve doing, but also what Border to Coast are doing. They're going to a different time frame, but they're able to put in resources that we in South Yorkshire were not able to put in. So we need to welcome that. There is an opportunity here for South Yorkshire to lead and for Border to Coast to lead, but we just need to understand those signposts. And George has said we need to have seminars to understand how we change our investment strategy. What are the key things we need to do to get us to keep us on track? It's the right thing to do. We are making good progress, but it's going to be a challenge to get there. It's going to be a challenge year on year, and we just mustn't take our eye on our targets.
I just wondered if you're connecting with other councils in South Yorkshire, because I know in Rotherham we're doing a lot in regards to net zero, and are you working with the other areas so that we're all on the same page?
We're operating in a very different sphere to the councils in terms of the councils decarbonising their areas. There are, however, projects the councils might come up with that could, if packaged in the right way, become investable, and that might form part of what we invested in terms of the levelling up plan. So the idea of creating geothermal energy from the closed coal mines, if produced as an investable proposition, is something that I would certainly be very interested in as investing in, and we would certainly give it a serious look. And I very regularly have conversations with the councils about things like that, generally on the basis, go away and bring me an investment proposition that I can examine as an investment proposition, because I'm not giving you a grant, because I'm not a philanthropic institution. But that message is getting there, and so there may well be some opportunities, but much of what the councils are doing is in that sense much more practical. So buying a load of electric vehicles to replace the vehicle fleet, or fueling your bin wagons through biodiesel and things like that. Really important things to do, but not necessarily things that would be investable from our point of view. But where there are those overlaps, we do have conversations, but we've not managed to come up with something that I could justify spending due diligence on at this stage. But I've no doubt they will do.
Okay, right. Fran,
do you know that how we compare with other pension partnerships or people who are operating in the same sphere, or whether there's a kind of national discussion around that?
I mean, there's significant variation across the local government pension scheme between the pools. You know, one of the Environment Agency Pension Fund, bizarrely, is a local government pension scheme fund. Don't ask me why historically, but it is. Clearly, the Environment Agency has something of a particular perspective on climate as an issue, and that's reflected in the way its pension fund is managed. And that has a significant impact on the pool in which they participate in terms of the way it does things. But you know, I wouldn't have said we were necessarily at the head of the pack, but we're nowhere near the back of the pack. I think we're probably within border to coast, and I'll let Mark sort of correct me, we're probably the ones sort of trying to push border to coast forward, but there's always got to be someone doing that. And you know, I wouldn't have said the resistance was necessarily coming from the operating companies in most cases, because the company in fairness are very open to the discussions and the ideas. Some partner funds have slightly different views on how to weigh the balance of these things, because what we're doing here is taking a view about the scale and impact of a particular risk if we don't do something, and what's that going to mean for the long-term value of our investments. And we've taken a particular view on that. Other people can weigh the same evidence and come to a different conclusion, because elements of the process are ultimately subjective. Those lead to interesting debates.
I work with 3 other funds as well, just to give it a little bit of perspective. I would say you definitely are at the forefront, and just as Councillor Sanger said, you set an aggressive target. You wasted no time in starting to understand what you own and how you can do better in terms of reducing that carbon impact, as well as looking at really climate solutions, which are an important part of offsetting that, or at least the compromise to set alongside that. So I'd say we should be encouraged by that, but obviously there's more work to be done. But definitely the target of 2030, most funds will be setting a 2050 target at this stage.
Yeah, if I could add, I think you're pushing in an open door here, everywhere. Everybody's, I think in general, everybody's coming around to your view. It's more about implementation than it is about the actual view. It's how to implement this effectively, how to get investment processes changed the right way, how to find opportunities to invest in, how to get the metrics so that you can actually understand it all. It's really more in that phase that the issues are going to arise, I think.
Okay. Gary?
Yeah, thanks, Chair. It's going back to what I said here about the working party, because we as members, we're getting, we talk to our groups, and they're telling us what we should be invested in, and then we're sitting, like Steve says, at the end of the day, we've got to pay pensions out. You know, nothing wants a lesser pension. You know, so we've got things to do. Yes. Well, you know, so. But you've started, so 2030 is a starting point, isn't it? So we're all working for that. But I think local investment, what everybody's after, we've got unions after us, we've got comrades, we've got people in all South Yorkshire saying to us, you know, why are you investing in this, and why are you still investing in fossil fuel? I mean, them emails we've had, all of us. You know what I mean? It's well put together, well thought through. So like Steve says, we've still got to pay that, but we've started something now, and it's going to carry on. You can't stop it, can you? You know, we all want to do something better. Like Chris has said earlier about the trains, you know, planting trees and things like that. So all that's local stuff we can be looking at to invest in. But like George said, you just can't give it a grant to. You know, so work into a policy for us. and I think that working group's going to be interested to see what the news out. Morning.
It's still there, but it's work in progress to get that goal all the way through. Yeah. Comments, question, anyone on the space? If not, can I go to the recommendation there, which is to approve the update net zero action plan? Are we agreed? Agreed. The next agenda item, colleagues, is agenda item 13. It's understanding the impact of our investments, and George is yours, page 115 to 158.
Thank you, Chair. Given the time, I suspect we shouldn't spend a massive amount of time on this, and members might want simply to note the report at this stage as we plan anyway to have a more in-depth discussion on this report. But this is the culmination of a piece of work that's taken more than 12 months in terms of analysing and then understanding where our investments impact on people and planet. From that we can then hopefully frame what our priorities in terms of some elements of our responsible investment strategy and so on are in future, and perhaps other things as well. If I'm honest, the work hasn't quite met some of my ambitions for it, but I think I was probably over-ambitious, but there's nothing wrong with that. On the other hand, I think it provides much greater understanding for our scheme members about the nature of what we are invested in at an underlying level, and that's very important. And we will continue to develop that. The contract we have with Minerva is for 3 years, so we're looking at three iterations of this to get to where we need to get to. So at this stage, I think I'd simply ask members to note the report. I'm happy to try and answer questions. I mean, it does draw out some interesting things in terms of some of the negative impacts that we, on the scale that perhaps we haven't anticipated, which are a function of the nature of some of our portfolios. And the other elements of the report is simply to sort of recommit ourselves to the impact investing principles, which we did at this time last year. Happy to take questions, Chair.
Yes, Gary.
When will this be bring that?
We'll bring this back to an informal session with members. What I want to do is get one of the people who worked on the report and to come and talk to members about it, because that will give you much more information and understanding than I can give you, because they lived and breathed having to produce it.
Any other comments, questions, colleagues?
Well, I just like to comment to say how well it read. You know, all the information is there. I was quite overwhelmed with what was in there, so very good.
Can you say, please excuse my English, what does NACE stand for?
I don't know, but it's a standard way of classifying industries. It's actually in the report, but I couldn't find it. I tried to find it now.
Can I just welcome the idea that George said that informal discussion will take place? If we have the informal discussion, page 145 on this particular will be helpful to bring with you, to conclude. There's some points in there that might stir us to do, get good ideas. Good ideas into what we can do with it. But like George said, it's a really, we'll have to discuss it more and more with the informal side inside. If there's no other questions, because I'm conscious of the time, can we move to recommendation, which is consider the authority's first impact report and determine whether any specific action should be undertaken in relation to the information contained Or B, no review of the authority's first year of adoption of the impact investing principle to principle. Do we agree, colleagues?
Agree.
Colleagues?
Can't wait for the person who wrote the report to
This is the director's report here, and it's on pages 159 to 180, and it's George.
Yeah, thank you, Chair. This is the regular responsible investment update. I'm happy to take questions, but I think this report is, in general terms, more about putting information in the public domain and through that showing our accountability to stakeholders such as scheme members. A matter for debate.
Questions, comments, colleagues? No? Are we agreed?
Agreed.
Very good, yeah. The next director is 16, which is the initial assumptions and delivery plan from 181 to 186. Again, I think it's George, right?
Yeah, thank you, Chair. I'm just very briefly going to say a few words, and then I'll introduce Douglas Green, who's the new fund actuary from Hymans Robertson, who's going to talk to you a bit more about why we have assumptions and things, rather than us getting into a debate about the detail of any particular assumptions, because they're derived from quite complex mathematical models. I think the important thing to highlight is at paragraph 5.2 in the text in italics, which is what we're aiming to set as an overall objective for this valuation process, which is essentially to look to achieve longer term stability in contributions. I will talk at another time more about what our initial modelling is telling us on that, but it wouldn't be appropriate to discuss that in public at this stage because it is initial modelling. But beyond that, I'm going to ask Douglas to talk about the assumption process, and Douglas has some slides which will magically appear on the screen.
Douglas, what's your surname, please?
Douglas Green. Green has in the colour. And so, as George says, and actually there's myself and Catherine McFadden, both at Hymans Robertson, your new actuaries, and I think some of you were at a training session we did online back in November as well. We touched on some of this. And I've been at various committee meetings of other funds round about. I've been interrupted by brass bands and by Extinction Rebellion protesters, never by an ice cream band. That's a new one. So we'll wait to see what happens. And if you remember from that November session, I spelled out that in financial terms, what the fund does boils down to three things. It collects money, it then invests that money, the assets that we've been talking about a lot today, and then it pays the money out as benefits to members as and when they retire, and to the dependents as and when they die. And that is the whole purpose of the fund. Okay? We must always focus on that. The valuation sort of wraps all those three things together, and in particular the assumptions that we make. So I'm going to work backwards to say, how do the assumptions work when we apply them to the members' benefits? How do the assumptions work for investment returns? And then how does all that come together to affect the employer contributions? Remember, you've got over 500 employers and they're all paying different levels of contributions, and the poor actuary has to sit and work this out for every single one of the 500 employers. Okay, but that's our problem. You want. So
we've seen your fees, Douglas.
Yeah, I don't see much of all of that. So working at member level, first of all. So what does it mean for an individual? So Joe or Josephine Bloggs is in the fund, and they joined at age 40, and they'll retire at 66 or 67 or whenever, and they will get a lump sum payment tax-free at that time, and then they start getting a pension which is paid for the whole of their life, and that pension increases in line with consumer price index inflation. And if they have a qualifying dependent, a widow, widower, whatever, at the time of their death, that dependent gets a pension for the rest of their life that increases in line with CPI inflation. Now, all these benefits are fixed in Westminster regulations. Okay, this This authority can't change that, I can't change that, George can't change that. But so that is the target we need to aim for. And we need to try and get as good a handle as possible on how much money are we going to need to pay out in these future years. Okay, there's no point, we can't try and negotiate it, okay, because they need to be paid out. So we want to get an accurate idea, and that's where assumptions come in at member level. So we will look at things like, and they're summarised briefly in the George's paper, but you know, how much will the member's salary increase up to the time they retire, because that affects some of the pension they get. How much of the pension do they commute for cash? You know, they convert pension to cash. The revaluation rate that most members are earning just now, it revalues in line with inflation up to retirement. How many will retire due to ill health? When the pension starts to be paid, it increases in line with CPI inflation. What do we think that level of CPI will be? A higher rate of inflation means bigger benefits, bigger costs, bigger employer contributions, or vice versa. And how long do we think members will live in retirement? The longer that they live, then the more the benefit costs, and therefore the higher employer cost, and vice versa. And I'll come back at the end. I've got a couple of charts that you'll see in the pack already. A bit of grim humour in there about life expectancy. So that's assumptions at individual member level, and we calculate that for all your 170,000 or so members individually. We can plot what we estimate, what we assume the benefit payments will be in all the years in future for each one of the members, and then we add them all up. And Richard, please, when we add that, if you go to the next slide, and altogether, when you add the 170,000 together, it looks something like this. And this was the picture roughly from the last valuation. And the pink lines are showing the nominal values. So we think that actually in round about 2040, you'd have an annual pension bill that's approaching the sort of £500 million mark in nominal terms, which sounds astonishingly scary, but hold on. And that will dwindle as and when pensioners are dying and stopping getting benefits. But you don't, and if we added all those payments up together, that would be, you know, approaching 20 billion or something like that. But you don't need 20 billion. You don't need 500 million just now to hold under a mattress to pay in 2040. You know that you're getting investment returns. And therefore we can discount all those projected benefits back to the present day and allow for how much roughly on average will your investments be doing the heavy lifting. And for instance, if we allow for 3.9% per annum, which isn't huge in terms of your aspirations, we'll come back to that in a second. If we discounted it by 3.9%, the total present value fell to the 8.5 billion that was shown in your valuation report in 2019. So that, in present terms, you don't need the 500 million, you need like half of that. Okay, so it's not as scary as it looks, and we're doing all the sums. So that investment return assumption is making a huge difference. So we were talking about the assumptions underpinning the benefits that we need to pay. Now we're saying, well, how much heavy lifting are the assets doing? And Richard, if you go on to the next slide. And this picks up, somebody was asking, I think it was you, sir, were asking about the actuarial return or something that was quoted. And I think, Sharon, you were saying about how it's like the underpin, as long as we're earning more than that. So Scottish actuary, I have to be prudent, okay, I have to be quite kind of gloomy about things. We can't just go by 50-50, sort of best estimate, sort of toss a coin about whether you're going to achieve it or not. We have to be on the prudent side. What this analysis shows here, and this is for your fund that we carried out for you not long ago, it says when we look at your investment portfolio and we do all the clever pointy-headed modelling stuff looking out over the next 20 years, and then we average that out, how likely is it that your portfolio will return a different level of annualised return over the next 20 years? So how likely is it that it will at least keep its value? It's near enough 100%, and the higher the return, the lower the likelihood. So technically there's a possibility you could get 12% per annum on average for the next 2 decades, but we're only thinking it's like a 1% likelihood of that. Think of it like a high jump. Okay, as you raise the high jump, fewer and fewer of the athletes manage to hurdle it. So as we move up the annualised return assumption, there's lower and lower likelihood. And if we were to pitch it at 50-50, you might say maybe 5.5% a year. Remember, this is every year for 2 decades on average. But something like 70% likelihood, that's a typical measure of prudence used throughout the LGPS. And if we pitched it about there, it's sort of just over 4% per annum. Okay, so that's a deliberately prudent, like the actuarial return. We obviously expect that the fund will deliver much more than that, but we have to be prudent for contribution setting purposes. Okay. So Richard, if you can go on one, and then, so this is going on to the third bit. So we talked about the member benefits, the assumptions underpinning them, then the assets, the asset return assumption, that's 70% likelihood, 4 and a bit percent, so forth. Now, what difference does that make to employer contributions? Don't worry about the detail of these, they've been anonymised anyway. We've done some detailed modelling on a number of the employers within the fund already, and we have modelled different contribution strategies. So what we've said is, suppose their contribution was frozen, suppose their contribution went up, suppose their contribution went down. How likely is it that they will be fully funded in the long term? And we've drawn the pink line at the 70% mark. Okay, so that's the required level of prudence. And you get different answers for different employers. So for this employer over here, fixing it at their current rate, yeah, that's okay. That should be fine. They can keep their contribution at least for the next 3 years. This employer here, when we did the same analysis, we said, no, fixing it at the current rate is only giving you 64%. It's not quite hitting the 70% prudence. So to be consistent across employers, this employer would need to step up its contributions by 1% per annum in this particular case. As George says, we've just started having those discussions, and we can't go into any more details of that at the moment. But the point is that we're holding all the employers to a consistent, prudent standard. So when you add it across the whole fund, for all the 500 plus employers, then you've got comfort, you've got the right amount of money coming in. Okay. Like I say, you don't need to go into the detail of that. The crucial thing for you to take away is that we are holding employers to a consistent standard across the board. I'll just pause there for a second. I've just got a couple more slides, but it's the grim humour about longevity in a second. But I'll just pause there. Any questions on what I've quickly gone through so far?
Comments, questions, colleagues? Anybody? I'll read you what my advice says in Gary here. It's the way you present it. It's very understandable. Well done.
That's the last time that's been said of that attitude tonight.
Yeah, we're not opening that black box at the moment.
And the last couple of slides, I mentioned earlier, one of the assumptions we make to say how much will the member benefits cost is life expectancy. So the longer we expect someone to live, then the more money needs to be set aside. And the shorter we expect them to live, then the less money needs to be set aside. Again, you're not going to negotiate with people how long they're going to live. We just want to get a handle on it. And we have a sister company, Club Vita, who do analysis across the whole of the UK. They've got the biggest database on this stuff, millions of pensioner lives. And they can see how long people live depending on whether they're male or female, when they were born, their level of earnings, and where they live. So they can drill down to 4-digit postcodes, and they can paint pictures like this. So you'll recognise this map, but the darker red areas are where there is lower life expectancy, all other things being equal. And the darker blue is where there is higher life expectancy, all other things being equal. And the white is sort of average life expectancy. And then you can see how this varies across. So typically we'd expect to see in big towns, as you get closer to the centre of the likes of Sheffield and Rotherham, it gets darker red. That's quite expected. But you can see all these other bluer or whiter areas round about. The significance here is that we then use that at each of those 170,000 members live. Okay? So that we get an idea that member with that benefit, we think they might live X number of years. That other member with that benefit might live Y number of years. We don't just apply one average across everyone. We allow for the fact that people have different life expectancies because of their postcode and their salaries. And we don't write out and tell them this, okay? But we do actually build to the analysis. And in case my final slide next, in case you think this was a little bit, this is Glasgow, right? So practically the only blue bits in Glasgow are the River Clyde and the M8. And final point, so my mum lives there in Bearsden, next door to Drumchapel, and you can literally drive down a road, the Peel Glen Road it's called, and there is something like an 18-year life expectancy drop just by driving down that road. It's the biggest consecutive postcode gap in life expectancy in the whole of the UK. So, right, we're not using that. So, Richard, if maybe you want to go back to one slide, we can leave that up if people want to ponder that a little bit.
You're moving into your house.
Look, the other side was almost as nice one.
But that was all I was going to say on assumptions generally, and perhaps any other questions?
I was understanding all the slides, and then when you started talking about now we can actually pinpoint when people's going to pass, it just...
Yeah, unfortunately, we need to take out of that sort of thing.
Demographics for you, don't you? Yeah, you're right, Gary. It's not a demographics for it.
You know, on the slide where you were saying about it's 64% and you haven't got to 70%.
Yeah.
What can we bring? Do you have to pay extra benefits to get you to that 70%?
No, so the 64%, 70% was if that employer was going to just carry on paying the contribution it currently is, then we think there is only a 64% likelihood that they will be fully funded in the long run. So they're not, we don't think they're paying in quite enough. And to be consistent across their peers, they should be upping their contributions a bit so that they've got a higher likelihood. If they put in more contributions, they'll have a higher likelihood of being fully funded.
Maybe asking George. So do we write out and set
we have the plan that's the series of boxes towards the end of that report sets out the process we're going to go through. So for the councils and the further higher education institutions, we've begun those discussions already based on modelling, because those are the largest employers, they are long-term employers, and so, but for the bulk of employers, largely the academies, because they're the largest single group of employers, we will be having those discussions over the summer. And those discussions are held in the context of our proposals for the funding strategy statement, which is essentially most of what's in this report.
And that's a real summer, that's not a Westminster summer.
Yeah, that's a real summer. Yeah, so we will be having some, and I'll talk about this in the informal discussion later. The results are likely to be quite employer specific, because each employer has a different membership profile.
Yeah.
I mean, group employers that have broadly similar profiles, but those are broadly similar.
Thanks for that, and that's reassuring that we are letting members know that if they hopefully that's the outcome going to be that. Because if you talk to my son at 30-year-old, he's saying now I'm not about a pension now. I said, well, the older one, you're 60. You know what I mean? So it's and if you get into that age where you can start bringing more in, hopefully it's what you want to get that message across. Thanks.
Yes, David.
You said about life expectancy, and there's obviously graphs.
Yeah.
They've changed quite substantially over the last few years.
Yes.
To say that people are going to live longer. Is that borne out from when those changes were made? As in, are people living longer, or with your data, are people living longer, or with the South correlating to that data, or are we coming back to the older tables?
Good question. I hadn't touched on it. So this is more about current expectations, but you're quite right, and it says in the paper there is a separate assumption about how life expectancy will increase in the future. So in very crude terms, people live roughly a decade longer. Their life expectancy is a decade longer than their grandparents' life expectancy, and that has been observed quite strongly. It started to tail off about 10 years ago. It sort of stalled a little bit. But we do still expect it to continue to rise. It has been very evident in the past. We continue, and the Club Vita continually pick up this data to keep a handle on that as well, though.
Okay. Chair. Any other questions, comments? Good, thank you. Well done.
Thank you.
We now come to the next agenda on papers.
So, Chair, you need to resolve to formally exclude the press and public.
Yeah. Can we formally agree to exclude the press and public? Agreed?
Agreed.
Joe?